Committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time. This hearing is entitled to semi-annual testimony on the Federal Reserve's supervision and regulation of the financial system. I now recognize myself for 3 minutes to give an opening statement. The Dodd-Frank Act requires the Federal Reserve's Vice Chair of Supervision to testify before our committee twice a year regarding the Fed's supervision and regulation of financial institutions. Regrettably, 5 years after the passage of Dodd-Frank, no such person exists. President Obama has been either unwilling or unable to follow the law and appoint a vice chair. We can no longer wait for the president to do his job so that we can be allowed to do ours. Thus, Chair Yellen appears before us today in substitution. As we know, Dodd-Frank rewarded the Federal Reserve with vast new sweeping regulatory powers despite its contributions to the last financial crisis. Under the Dodd-Frank, the Fed can now functionally control virtually every major corner of the financial services sector of our economy, separate and apart from its traditional monetary policy authority. Disturbingly, the Fed does so as part of a shadow regulatory system that is neither transparent nor accountable to the American people. Simply put, the Fed must not be allowed to shield its vast regulatory activities from the American people and congressional oversight by improperly cloaking them behind its traditional monetary policy independence. This is a vitally important point. What is clear is that despite the largest monetary stimulus in our nation's history and 7 years of near zero real interest rates, middle-income families aren't getting ahead and the poor and working class are falling further behind. Preliminary third quarter GDP growth is coming in at an anemic 1.5%. Our economy for 7 years has limped along at about half the post-war average. That means every man, woman, and thousands of dollars poorer than they should be, and millions could be fully employed who are not. Trillions of dollars in capital that could fuel robust economic growth instead remain sidelined due to a regulatory tsunami, much of it dictated by Dodd-Frank and promulgated by the Federal Reserve. Thus, why isn't the Fed subject to statutory cost-benefit analysis? Why has the Fed yet to find any connection between its Volcker rule or any other rule on market liquidity? Why do the stress test Kafkaesque kabuki dramas that combining the Fed's lack of transparency with its all-encompassing new regulatory authority under Dodd-Frank is a dangerous mix? It is a threat to economic growth, not to mention the principles of due process, checks and balances, and the rule of law. If we are not careful, our central bankers will soon become our central planners. Fortunately, the House will soon have the opportunity to reform the Fed and make it more transparent with the Federal Oversight Reform and Modernization Act offered by our colleague, Mr. Huizenga, and approved by this committee. I now yield 5 minutes to the ranking member for an opening statement.
Thank you, Mr. Chairman, for holding this hearing, and thanks to Federal Reserve Chair Yellen for making herself available to testify. The 2008 financial crisis inflicted staggering damage to our economy. Within the months before President Obama took office, employers shedding more than 800,000 jobs a month, unemployment topping 10%, home foreclosures displacing millions of families, and entire industries on the brink of collapse. Congress responded to this devastation by passing the most comprehensive overhaul of our financial system since the Great Depression, the Dodd-Frank Wall Street Reform and Consumer Protection Act. The act entrusted significant responsibility to the Federal Reserve and directed the Fed to improve its supervisory program so that another crisis of such scope and depth would never happen again. Recognizing that the Federal Reserve failed to apply appropriate prudential standards to large banks, Congress directed the Fed to impose enhanced requirements for capital, liquidity, resolution planning, and other factors to ensure that no large bank or group of banks could again endanger our economy. I'm eager to hear from Chair Yellen on the progress of these reforms, along with a description of how the Fed is using the flexibility embedded in Dodd-Frank to tailor regulations appropriate to the sizes and risk of different types of bank. Congress specifically permitted the Fed to differentiate among companies on an individual basis or by category, considering their capital structure, riskiness, complexity, financial activities, size, and other factors. The Fed should use this authority. Likewise, Dodd-Frank provided the Fed with new responsibility to collectively regulate the activities of systemically risky non-banks entities such as the insurance company, AIG, whose near failure imposed dire systemic consequences on our economy just 7 years ago. I very much would like to hear from Chair Yellen about how the Fed has bolstered its expertise to take on these new responsibilities. And let me also express my deep concern about legislation this committee considered during a markup this week that would severely undermine efforts by the Fed to regulate both banks and non-banks. With regard to banks, the legislation would hamstring the Fed's ability to regulate all but the largest globally active banks, ignoring how the failure of many large interconnected regional banks could have dire consequences for our economy. Similarly, other legislation would undermine the Financial Stability Oversight Council's ability to identify supervisory gaps, designate non-bank firms for enhanced prudential regulation, and ensure that the Fed is regulating them on a comprehensive, consolidated basis. Finally, as we just have passed the 5-year anniversary of Dodd-Frank, I think it is important to remind the committee and the public of the need to be ever vigilant of the threat of another crisis. Among our supervisors, we must guard against complacency and regulatory capture. Among our law enforcement, we must hold institutions and individuals accountable, something that former Chairman Ben Bernanke in his recent book said that we did not adequately do. And here in Congress, we must be mindful of attempts to defund and defang Dodd-Frank. The American economy has made substantial progress since the depths of the crisis, but that progress will be threatened if we do not protect these reforms, both in statute and in practice. So thank you, Mr. Chairman, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of our Financial Institutions Subcommittee, for 2 minutes.
Thank you, Mr. Chairman, and good morning, Chair Yellen. Today marks the first time since the passage of Dodd-Frank that someone from the Federal Reserve has testified under the authorities bestowed upon the statutorily created Vice Chair of Supervision. Yet today the person testifying was not appointed or confirmed for that position. I remain baffled that the President has failed to put forth a single name to serve in this important role. I fear it is largely because Federal Reserve Governor Dan Trujillo, who serves as chairman of the Internal Committee on Banking Supervision, can already exercise many of the authorities and in de facto capacity, free from any meaningful checks and balances. As you know, the Federal Reserve, in addition to its monetary policy operations, regulates and supervises financial institutions. Many of them are some of the largest in the world. Over the past few years, we have seen significant rulemaking driven in large part by the Federal Reserve that have significantly altered the bank capital structures and artificially manipulated liquidity. Annual stress testing under the CCAR process, arguably the most important exercise a bank must do each year, remains completely opaque and free from any meaningful oversight. Further, the Federal Reserve plays an integral role in the forums where international banking supervision and regulation standards are advocated and implemented. Together, these important regulatory operations of the Federal Reserve deserve much of our needed attention and oversight. Today, I hope Chair Yellen will address some of the more intricate points of bank regulation and supervision. Specifically, I look forward to gaining a better understanding of how she sees each major capital and liquidity rulemaking working together. Additionally, I look forward to learning how the Federal Reserve analyzes the market implications of institutional regulations. We have already seen unintended consequences in the bond market where liquidity and volatility concerns have been raised as a result of institutional regulations like the liquidity coverage ratio. Finally, I look forward to her thoughts on how to make CCAR more transparent. She also must address how major regulation factors into and is prioritized under the CCAR stress environment. Thank you, Mr. Chairman, and I look forward to this important hearing.
Today, we welcome the testimony of the Honorable Janet Yellen. Chair Yellen has previously testified before our committee, as all know, so I believe she needs no further introduction. Without objection, Chair Yellen, your written statement will be made part of the record. You are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you for being here. I think you need to hit the microphone there, Chair.
Chairman Henserling, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to testify on the Federal Reserve's regulation and supervision of financial institutions. One of our most fundamental goals is to promote a financial system that is strong, resilient, and able to serve a healthy and growing economy. We work to ensure the safety and soundness of the firms we supervise, and also to ensure that they comply with applicable consumer protection laws so that they may, even when faced with stressful financial conditions, continue serving customers, businesses, and communities. This morning, I'd like to discuss how we have transformed our regulatory and supervisory approach in the wake of the financial crisis. Before the crisis, our primary goal was to ensure the safety and soundness of individual financial institutions. A key shortcoming of that approach was that we did not focus sufficiently on shared vulnerabilities across firms or the systemic consequences of the distress or failure of the largest, most complex firms. In the fall of 2008, the failure or near failure of several of these firms, many of which we did not supervise at the time, sparked a panic that engulfed the financial system and much of the economy. Today, we aim to regulate and supervise financial firms in a manner that promotes the stability of the financial system as a whole. This has led to a comprehensive change in our oversight of large financial institutions. As my written testimony describes in more detail, we have introduced a series of requirements for the largest and most complex banking organizations that reduce the risk to the system and our economy that could result from their failure or distress. In addition, we now supervise financial institutions on a more coordinated, forward-looking basis. At the same time, we've been careful to make more measured changes in our approach to regulating and supervising firms at the other end of the spectrum. We're committed to ensuring that the supervision of smaller institutions is tailored to the business model and activities of individual institutions. In supervising community banks, we're refining our risk-focused approach, which aims to target examination resources to higher risk areas of each bank's operations and to ensure that banks maintain risk management capabilities appropriate to their size and complexity. Given the important role that community banks play in their communities and the economic support they provide across the country, we recognize that supervision of community banks must be balanced and measured. The regulatory reforms we've adopted since the crisis addressed the risks posed by large financial institutions in two ways. First, our reforms reduce the probability that large financial institutions will fail by requiring those institutions to make themselves more resilient to stress. However, we recognize we cannot eliminate the possibility of a large institution's failure. Therefore, a second aim of our post-crisis reforms has been to limit the systemic damage that would result if a large financial institution were to fail. Again, my written testimony provides more detail, but I wish to highlight for you two examples of how we're addressing this too-big-to-fail challenge. First, to limit the systemic effect of a large institution's failure, the board and the Federal Deposit Insurance Corporation have adopted a resolution plan rule that requires large banking organizations to show how they could be resolved in an orderly manner under the bankruptcy code. Second, the board just last week proposed a rule setting long-term debt and total loss-absorbing capacity requirements for the very largest banks in the United States. With the new requirements, if losses were to wipe out a firm's capital and push a firm into resolution, a sufficient amount of long-term unsecured debt would provide a mechanism for absorbing losses and recapitalizing the firm without generating contagion across the financial system and damaging the economy. In addition to strengthening the regulation of the largest, most complex financial institutions, we have also transformed our supervision of these firms. Our work is now more forward-looking and multidisciplinary, drawing on a wide range of staff expertise. We put this new approach into operation with the creation of the Large Institution Supervision Coordinating Committee, or LISIC, which is charged with the supervision of the firms that pose elevated risk to U.S. financial stability. The LISIC program complements traditional firm-specific supervisory work with annual horizontal programs that examine the same firms at the same time on the same set of issues in order to promote better monitoring of trends and consistency of assessments across firms. For example, our Comprehensive Capital Analysis and Review, or CCAR, ensures that large U.S. bank holding companies, including the LISIC firms, have rigorous, forward-looking capital planning processes and have sufficient levels of capital to operate through times of stress. I would note that capital at the 8 largest U.S. banks alone has more than doubled since 2008, an increase of almost $500 billion. Our new regulatory and supervisory approaches are aimed at helping ensure these firms remain strong. While more work remains to be done, I hope you will take away from my testimony just how much has changed. Our supervisory approach is more comprehensive and forward-looking, while also tailored to fit the level of oversight to the scope of the institution and the risks it poses. And the Federal Reserve is committed to remaining vigilant as a regulator and supervisor of the financial institutions that serve our economy. Thank you. I would be pleased to respond to your questions.
Chair now yields himself 5 minutes for questions. Chair Yellen, the first couple of questions I have deals with the concern, has the Fed crossed the line from being regulator to manager? We've had a number of individuals come to our committee to tell us that Fed officials have regularly attended corporate board meetings of the systemically important financial institutions under the Fed's purview. Is that true?
So I'm not sure if that's true. It is not.
So you are unaware of any Fed officials attending board meetings?
It's conceivable that that might have occurred. I'm not saying that it did not occur. I'd have to get back to you.
If it did occur, what legal authority would you cite for having employees of the Fed invite themselves into corporate boardrooms?
So I don't know what the circumstances are in question, but I can, for example, tell you that when I was president of the San Francisco Fed, that I occasionally would attend a portion of a board meeting of one of the firms that we supervised to make a presentation to the board about our supervisory findings and the emphasis.
But you are unaware of any Fed officials attending these board meetings? You have no personal knowledge of this, and this is not a policy of the Fed?
I really don't have details about what Fed officials
We would
have
appreciate
done.
it if you could look into this, Chair Yellen, and get back to the committee on this matter. We've also heard from individuals with respect to the stress test, which, you know, we have had both public dialogue and private conversation. Many of us on this committee considers that to be, again, a rather opaque process. And so this committee has a number of questions. We've also asked members of the employees of the financial institutions who've been on the receiving end of these stress tests. We have been informed by numerous individuals that they have been told by the Fed not to speak to members of Congress about the stress test. Do you have any knowledge of this matter?
I have no knowledge of that.
Okay. Is it the policy of the Federal Reserve to instruct members of banks subject to the stress test not to speak to members of Congress?
I strongly doubt that that's our policy.
Okay, you are unaware of that being a policy. Would you object to these people speaking to members of Congress? Can you let it known to your employees that they should not be telling private citizens not to speak to members of Congress about stress tests?
I think private citizens can interact with members of Congress.
You're willing to direct your employees to ensure that that dialogue can take place?
I will certainly look into that.
With respect to the stress test, and again, great concern about how opaque and non-transparent these affairs are, I guess the first question I would have is, we don't doubt that you have many serious employees, very smart regulatory staff who handle these matters, but we still don't know much about this. How is the market, how are market participants supposed to be convinced that we have less systemic risk when they have no insight into these tests, since members of Congress have little to no insight into these tests? How are we supposed to reaffirm market confidence?
So we do a great deal, in my opinion, to explain the methodologies that we employ. We've published overviews of the methodologies that we use, and we update those every year. They include detailed information about the scenarios, the analytic framework we use, and information on the models that we
I guess,
employ.
Chair Yellen, detail may be in the eye of the beholder because members of Congress still don't understand this, and in our dialogue with banking organizations, they still don't understand the test either. In the remaining time I have, one last question. Again, with respect to these tests. So the stress tests really have become, in many respects, your main tool, your main supervisory tool for the large banks. But my concern is if you have one centralized view of risk and you're imposing that view on our large banking organizations, to some extent, isn't that exactly what Basel II did in telling banks that they essentially had to reserve little to no capital against sovereign debt and mortgage-backed securities, think Greek bonds and Fannie and Freddie? How can that lower systemic risk if we only have one centralized view of risk, and it may be wrong?
Well, I guess I would dispute the idea that we have one centralized view of risk. The purpose of this exercise is to help the firms develop their own analytic capability to model the impact of various stresses on their organizations and to develop a robust capital planning process, which is what we evaluate in our CCAR exercise.
Well, Chair Yellen, I wish we could conclude the same thing, but we have insufficient information about your stress test to be able to come to the same conclusion that you make. I'm over my time. The Chair now recognizes the ranking member for 5 minutes.
Thank you very much. I'm pleased to see you, Chair Yellen. And unlike the chairman, along with many of my colleagues, we've heard from regional banks about the comprehensive capital analysis and review, or CCAR stress tests. And they have complained that they're not sufficiently calibrated to the unique profile of large bank holding companies that focus on traditional banking activities. We've also heard that the annual filing of living wills is cumbersome for the banks and not particularly helpful for the Fed's supervisory process. So I have no indication that they've been told not to talk to us. They talk to us plenty, and we're listening. At the same time, Congress is considering legislation that would do severe damage to the new standards the Fed has implemented and their ability to identify and respond to risk in the future. So, can you discuss why H.R. 1309, a bill debated by this committee yesterday, which addresses this topic, would be severely damaging to the Fed's ability to respond to systemic risk on an agile and comprehensive basis. Secondly, will the Federal Reserve commit to doing further tailoring using the existing authority provided by Section 165 of the Dodd-Frank Act, specifically on the two issues I cited earlier, CCAR stress test and living wills?
Your microphone, please, Chair.
Pardon, sorry. I am concerned very much about a process that would require, as I understand 1309, would require the board to use a statutorily defined set of factors or make findings based on factors to decide whether or not to subject firms to higher prudential standards. I would see such a process as inhibiting our ability to take timely and necessary supervisory actions to address a firm's risk. We do a great deal of tailoring of our supervisory approach to make sure that it is appropriate to the size, complexity, and systemic risks posed by a particular firm. We're committed to doing that, and we are looking at further ways in which we can tailor our supervisory approach, in particular the CCAR process that we were discussing. We have some ideas about how we might tailor it, particularly for to apply to smaller firms. We have indicated that there are some constraints on our ability to tailor our supervisory approach for the smaller firms subject to the 165 requirements. In particular, Dodd-Frank requires that we administer stress tests and receive resolution plans. Our experience thus far is that the safety and soundness value of those requirements for the smaller of those firms probably is not sufficient to justify the costs imposed on them. And so we would value for the firms on the smaller end of the spectrum being able to relieve them of those requirements. But I do want to make clear that we do tailor our supervisory approach according to the complexity of the firm and are committed to doing that.
Well, I'm so pleased to hear that, because what we heard constantly yesterday was that you do not. That somehow they kept talking about one size fits all, and that you're not using your tailoring authority. So thank you for explaining that to us, and we are absolutely supportive of your being able to do that. We think it makes good sense, and perhaps what we need to do is work with your staff a little bit more to understand whatever restraints there are involved in tailoring, and whatever authority that you have and flexibility that you have. But thank you for clearing that up. That's very important. You know you have the authority. You understand that Dodd-Frank gives it to you. You use it, and you welcome any questions from this committee about how you use it and how you can't use it. So thank you very much. I yield back the balance of my time.
Chair now recognizes the gentleman from Texas, Mr. Nagelbauer, chairman of our Financial Institutions Subcommittee, for 5 minutes.
Thank you, Mr. Chairman. Chair Yellen, it seems like there are many different new regulations, and they're all kind of trying to drive at the same thing. And from an outsider, it's hard to see how they actually are coordinated. For example, just in one broad area, capital, we now have TLAC, we have the GSIB surcharge, the supplemental leverage ratio, the normal Basel risk-weighted capital regime, as well as the annual stress test known as CCAR. Can you walk me through how all of these capital rules fit together and what each are trying to address?
Microphone, please.
Yes, I mean, certainly. So we do see these rules as fitting together. Most of the requirements that you just mentioned are imposed only on U.S. GSIBs, the 8 largest U.S. firms. We think, given the risks that the failure of one of these firms would pose to the financial system, that it's important that they be subject to more stringent capital requirements, liquidity requirements, and ability to survive a very stressed event. And we think the various things that you mentioned coordinate with one another. In particular, we have put in place so-called GSIB surcharges that impose additional high-quality capital standards on the 8 U.S. GSIBs. And it's based on our estimate of the impact that the failure of one of those firms would have on the overall financial system. The supplementary leverage ratio, enhanced ratio, is a backup tool that works in a coordinated way. This has long been the case with the risk-based capital charges. And so we see those as working together. Now, the stress tests that we impose on these institutions are a very robust, forward-looking approach to assessing whether or not firms could survive a very adverse stress scenario and continue to serve the credit needs of the U.S. economy. And so these are coordinated approaches. The so-called TLAC requirement that you mentioned is a requirement that we think is necessary so that one of these firms, were it to fail, in spite of all of the resilience that we expect of it, that it would be possible, as Dodd-Frank requires, to resolve that firm under bankruptcy or alternatively under orderly liquidation.
So one kind of comes to mind here is, at what point does the CCAR process kind of override all of the other requirements? I mean, I guess literally they could be in compliance with these other requirements, but they could fail their CCAR. So is CCAR driving the regulatory process, or are these standards that you're putting in place, driving the regulatory process?
Well, I believe they're complementary, and I think that CCAR is a particularly valuable process because what we expect these firms to do is not simply to be able to meet some standard, a minimum capital standard, but what we want them to have in place is the internal ability to analyze the risks that face that unique organization and to have a rigorous capital planning process that firm is using to make sure, whatever our rules may say, we want that firm to make sure that they have adequate capital to survive a severe stress. And the stress tests and CCAR process are looking to make sure that they have governance and risk management standards in place that are designed for that organization and for the unique risk profiles that they are managing their risks in the way we would expect a systemic firm to be able to do.
But, I mean, each entity is different, and so, we're imposing many of these standards on all of them, I assume, somewhat on a consistent basis, but, the CCAR for one entity, the stress that entity may go under because of their business model is going to be differently. And so do you need all of these others if the final test is the big test here, the CCAR?
Well, we believe it's a belt and suspenders approach in that they work together in a coordinated fashion.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Chair Yellen, I'll get to questions about regulation in a moment, but first I'd like to ask one question on monetary policy. When you testified in July, you said in response to one of my questions that one of the advantages to raising rates a little bit earlier is that, and I quote, "we might have a more gradual path of rate increases," end quote. Of course, one of the downsides to starting to raise rates while inflation is still below target is that it could end up hurting the fragile economic recovery. Fed Governor Boehner recently said that raising rates too early could end up, and I quote, "prematurely taking away the support that has been so critical to the economy's vitality." So my question is, do you think the risks of raising rates in December, which will very likely be before inflation reaches the Fed's 2% target, outweigh the benefits?
Thank you for that question. So let me say that at this point, I see the U.S. economy as performing well. Domestic spending has been growing at a solid pace. Our trade performance, net exports, is soft, but the committee judged in October that some of the downside risks had diminished relating to global economic and financial developments. I see underutilization of labor resources as having diminished significantly since earlier in the year, although recently we have seen some slowdown in the pace of job gains recently. So with that sort of backdrop in mind, and of course inflation, I should say, is, as you mentioned, running considerably below our 2% objective. Nevertheless, the committee judges that an important reason for that relate to declines in energy prices and the prices of non-energy imports, and that as those matters stabilize, that inflation will move back up to our 2% target. So with that sort of economic backdrop in mind, the committee indicated in our most recent statement that we thought it could be appropriate to adjust rates at our next meeting. Now, no decision at all has been made on that, and what it will depend on is the committee's assessment of the economic outlook at that time, and that assessment will be informed by all of the data that we receive between now and then. So what the committee has been expecting is that the economy will continue to grow at a pace that's sufficient to generate further improvements in the labor market and to return inflation to our 2% target over the medium term. And if the incoming information supports that expectation, then our statement indicates that December would be a live possibility, but importantly, that we've made no decision about it. Now, it is, as you asked about the timing of such a move, the committee does feel that moving in a timely fashion, if the data and the outlook justify such a move, is a prudent thing to do because we will be able to move at a more gradual and measured pace. We fully expect that the economy will evolve in such a way that we can move at a very gradual pace. And of course, after we do so, we will be watching very carefully whether our expectations are realized. So when my colleague, Governor Brainerd, mentions that inflation is low, if we were to move, say in December, it would be based on an expectation, which I believe is justified, that with an improving labor market and transitory factors fading, that inflation will move up to 2%. But of course, if we were to move, we would need to verify over time that expectation was being realized, and if not, to just adjust policy appropriately. I think I'd also like to emphasize that I know there's a great deal of focus on the initial move. It's been a long time that interest rates have been at zero, but markets and the public should be thinking about the entire path of policy rates over time. And the committee's expectation is that that will be a very gradual path, and of course will depend very much on the actual performance of the economy.
The
Time of the gentlelady has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of our Capital Markets Subcommittee.
I thank the chairman. I thank the chair. So we've heard the other day about all the benefits that came out of Dodd-Frank and all the work that the Fed is doing overall. I want to go back and look a little bit deeper on that, both individually and cumulatively. So back in 1994, Congress passed and announced a law. It's something called the Regal Community Development and Regulatory Improvement Act. And as you're probably familiar, that applies to all federal agencies, including the Fed, that says you shall consider the costs and burdens that any regulations would place on depository institutions, small depositories. Basically, you have to do a look at the cost of regulations and also the benefits. Now, we do hear about the benefits. I asked this question to Governor Tarullo, have you done those individual cost-benefit economic analysis? And I didn't get a really clear answer from him whatsoever. So very briefly, in a sentence, do you believe that the Regal Community Development Act applies to the Fed, and then as such you're required to do a basic cost-benefit analysis each time you do a regulation? That's a yes or no, I guess.
We follow rules of the Administrative Procedures Act and always request public comment on costs of our rules.
And so you do an actual did you do an actual cost-benefit analysis, for example, on TLAC?
Well, we did do an actual cost-benefit on TLAC.
Do we have a copy of that?
And it is described in the proposal that we issued last week. So in some cases, we have done a cost-benefit analysis. In other cases,
in other cases, you do not?
Well, very often what we're doing is putting into effect a rule that Congress has directed us to write to implement changes that in Congress's view will be broadly beneficial.
You're doing the rule, and under Regal...
And then the question becomes, when Congress has directed us to write a rule that it's judged to be beneficial,
well, that's not,
what is the least cost way of doing that?
Let me just stop you there, if I may. The Regal Act doesn't say that you can pick and choose as to when you do a cost-benefit analysis. It says you shall, so not may, you shall consider, and then it lays out those parameters. So it sounds as though you're doing it in some cases, but are you not doing it in other cases, which may explain why Governor Tarullo couldn't give me a clear answer. Let me just move on to the broader issue then, since you're not apparently doing it in all cases. The broader issue is, and I asked this of your predecessor, Chairman Bernanke, I said, has anyone done an analysis of all the costs and the burdens to everything cumulatively of Dodd-Frank? And his answer was a famous no. And Secretary Lew, we asked the same questions, and his answer was basically no, but if Congress wants to do it, we can do it. So I'll throw that question out to you as well, since everyone else says that you haven't done it. Have you done a cumulative cost-benefit analysis on the regulations that as they go through and the burdens? Is your answer? Yeah?
I think the answer for the kind of analysis that you have in mind is probably no.
Okay.
But we are carefully monitoring what the effects of these rules are.
So let me ask you this. If you have not done, and I appreciate your candor on that, if you have not done a cost-benefit analysis cumulatively, yesterday Mr. Himes from Connecticut said FSOC came out with a report, and there's nothing in this report that shows the regulatory burdens is a cause of the effect, a negative effect on the economy. I just went through here the executive summary. There's about a dozen different factors that the FSOC came up with, and he's right. The regulatory burdens is not listed as a factor. But now I understand exactly why. Because you just told us that FSOC and the Fed never even did a cost-benefit analysis cumulatively. If you haven't looked at it, then of course it's not going to be in your summary of as one of the impacts, because you're not even studying it. So I guess this report is a little bit useless, isn't it? Because if you're not going to study the problem, then we really don't know what the problem is, isn't it?
I think it's important to take a step back here and to recognize that we lived through a devastating financial crisis.
I'll give you that.
The cost of that crisis to households, to businesses.
But so
The U.S. economy was enormous.
Is this a summary of any benefit to us at all if you're not going to do this, if you're not going to do the basic analysis?
We have done basic analysis. When we put in effect the capital rules and liquidity requirements.
You just told me that you did not.
We have looked
Excuse
at the
me.
costs and.
I appreciate that. But you just told us what everyone else has told us, that you have not done an individual analysis and you've not done a cumulative analysis. If you haven't done this study, if you haven't done it into the records, then your analysis is what's affecting the economy is basically useless.
Time of the gentleman has expired. Chair now recognizes the gentleman from California, Mr. Sherman.
Let me give you some advice in the other direction. There are a host of titles and provisions in Dodd-Frank, and there are a host of other laws that you carry out. The fact that they come to you in a political package called Dodd-Frank or they come in some other package is of great interest to politicians. But those are different titles. Just because a provision was in Dodd-Frank doesn't link it with another provision of Dodd-Frank or delink it from provisions of laws that were passed earlier or later. So I would hope in carrying out your responsibilities, you would look functionally, since the purpose is to give us advice how to improve derivatives regulation, how to improve a depository institution regulation, and leave it to the politicians to second guess bills named for politicians. We do get one benefit from the fact that the Vice Chair for Supervision has yet to take office, and that is we get to spend another day with you. This is of great personal joy to me. And from your standpoint, you get to spend another day with our chairman, who is the most prominent American named Jeb who does not use an exclamation point to spell his name. So there are some real benefits from that. I want to focus on interest rates. You came here in July, and I spent my 5 minutes laying out reasons why you should not then increase interest rates. My most gullible friends believe that I was successful in persuading you, and hence that is the reason why interest rates have not gone up. I have some gullible friends. But I want to keep doing it. As I argued then, back in the summer, God's plan is not for things to rise in the autumn. As a matter of fact, that's why we call it fall. Nor is it God's plan for things to rise in the winter through the snow. God's plan is that things rise in the spring, and so if you want to be good with the Almighty, you might want to delay until May. And I know there are a bunch of things you're aware of. Many economists say we shouldn't move forward now. Managing director of the IMF has been fairly candid. We've got deflationary risk. We just have a bad growth report. And you're aware of it, but you probably won't estimate it as highly as I will because of my occupation. But don't underestimate the ability of politicians in both Europe and the United States to screw things up. I mentioned last time you were here the psychological advantage to retirees of nominal interest rates of 4 to 5% so they can live on their retirement savings without a nominal invasion of principal. That psychological benefit is not in the GDP statistics. As a matter of fact, you reduce the GDP statistics because they're not going to psychologists and spending money, which would be part of the GDP, but it does enhance and then finally, as I pointed out to you, and I do want to talk to you privately about this, how FASB is coming up with this new $2 trillion change that will hurt construction, depress the economy. The other thing is that if you act too soon and you decide, oops, we acted too soon, you put yourself in a position first where you have a zigzag policy, and you will face criticism from that by some people I know. And second, if you then want to go in the other direction, you only got a quarter point to play with. So if you hit the brake too soon and decide, oops, I got to hit the accelerator, you don't have any gas. With that in mind, I'm concerned about the effect raising interest rates now would have on the real estate recovery, and I would ask you what you would think the impact would be of raising interest rates on the housing recovery, and would we squeeze credit-worthy borrowers out of the housing market and create a negative feedback loop with prices going down.
So you've made a large number of very good points and indicated many relevant considerations that the committee is trying to weigh and balance and has been taking into account. With respect to the housing market, of course, the level of mortgage rates is relevant to housing, and so we're very aware that, for example, a sharp rise in mortgage rates could have a very negative effect on housing. We do, however, have a recovering economy where employment is going up, income is going up, households are in better shape to form households, whether it's that they're moving into rental properties. The millennials seem to have a strong preference for later house purchases, but we do envision gradual recovery in the economy, in the housing sector. Let me come back to the point that I made earlier, which is the committee anticipates a very gradual increase in interest rates. We're not envisioning that when we begin to raise rates, we're going to be looking at a very steep path of interest rates that would cause the kind of harm that you're worried about to the housing sector. So that whole path matters, and that is a gradual path.
The time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. It's always interesting to listen to the gentleman from California. He's a very bright guy with lots of interesting correlations, but I've never heard of God's plan for the seasons correlated to the Fed's plan to raise interest rates. I enjoyed the discussion this morning, gentlemen. Welcome, Chair Yellen. This morning I want to talk a little about the designation, a SIFI designation of insurers. Very concerned that FSOC and the Fed have become the rubber stamp for the Financial Stability Board. It's my understanding that the FSB made the designations for global systemically important insurers without extensive analysis or information from the companies other than what was publicly available. So my question is that the case? And if you did not receive information from the companies, how did you reach the conclusion that they posed a risk to the global system?
Well, Congressman, in the case of the companies that were designated, in every case there was an extremely detailed evaluation that was done, and a summary of the evaluation is publicly available that did involve interaction with the company.
Did the analysis so come from FSB, or was it your own analysis?
This was the analysis of the FSOC. The FSOC and its staff prepared very detailed assessments of what the consequences would be for the U.S. financial system of the failure of one of these firms.
You know, it's interesting. That's not the question or the answer that we get from the insurance side of this, from the company side of this. Did you solicit any of this information, anything from them, or did you just take FSB's information and take that and try and analyze that?
We have detailed interactions with the companies.
You got information from them outside of what's publicly available?
Absolutely. I mean, part of the designation process, in stage 3 of the designation process, there have been detailed interactions with the companies. They have provided information. They have had every opportunity to weigh in and to offer their views of...
It's kind of, if I can interrupt just a second here, it's kind of interesting, though, that the one individual on FSOC who has some insurance background is the one who said, no, we don't need to designate them as systemically important, yet FSOC went ahead and did it. Can you enlighten us as to why that would occur? Why did the other folks who are not experts think that they needed to be designated where the expert said, no, we don't?
Well, we have a great deal of expertise in insurance on the FSOC and among the staff who look at this, and what I can assure you of is that very detailed analysis was done, firm-specific analysis of what the consequences of a failure would be, and the firms had ample opportunity to weigh in, and they very well understand what the
Well-
logic was of why they were designated.
All due respect, Chair Yellen, I'm not sure that they had plenty of time to respond because now they're going to court to try and resolve the situation. So I think if they could have responded to this, surely there would have been an ongoing discussion, could have minimized this, and they wouldn't be going to court. They would have agreed with the analysis or agreed with your designation. But
Well,
let
they
me,
may disagree, but they have had a detailed opportunity to weigh in. And in the case of one firm, now, I was only involved myself in the designation of one firm, and that firm had an opportunity to meet with the entire FSOC.
okay, well, I recently had the opportunity to meet with some of the international folks who designate the GSIFIs, and it was very concerning the way they went about it, and I think to take their analysis without any our own analysis is very concerning.
We have absolutely not
Okay,
taken international analysis to substitute for our own. We have done our own analysis.
I'll take
in
you at your
FSOC.
word. With regard to one other issue here, yesterday we passed out of this committee a bill to deal with a specific designation for banks. And in the bill, we have guidelines that actually you use, the Fed uses in their own analysis just recently in the BB&T and Susquehanna merger. And I was kind of concerned at the way that the question went and the discussion went with the ranking member with regards to the guidelines that are provided in our bill as being the only ones that are considered. I'm sure that you take those into consideration as well as other ones whenever you make that sort of decision. Do you not?
We try to tailor a supervisory program that we think is appropriate given our full understanding of the risk
The
characteristics
ones that
of the
detail in my
firm.
bill are ones that are significant ones that you believe that need to be used to provide the guidelines to make the designation.
We look at those factors, but we tailor an entire program that is specific to
I
the
appreciate,
firm.
on the previous testimony in this committee, you've agreed that those are important criteria, and you supported the bill, so I thank you for that.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chairman. Mr. Chairman, for the record, I want to clarify it. Some of us do use an exclamation point after your name, and in matter of fact, some of us use hashtags, star marks, a few other things that are in there too. So I just want to be clear. Some may not, but some do.
As long as you spell it right.
Madam Chair, first of all, thank you for being here again, and as always, it's a pleasure to see you. I have a few questions, and we're going to start on one that kind of has been a bit concerning me, and I think for the most part, most of us have been pretty quiet about it, and that's the requirements of Section 956B of the Dodd-Frank Act that requires the Fed and others to take action relative to executive pay at banks. And I want to be clear, I, for one, do not care how much anyone in this country makes. The how much is not my concern. The how is a concern. It is a concern in law because of the incentives that may be involved. Some of us think that those incentives had a lot to do with the 2008 problem, and yet the law says 90 days. Fine, okay, 90 days, 180 days, 360 days. It's now 2015. 7 years. 7 years. And we do not have a regulation on this issue. And I'm just wondering, could you tell me, when do you think we might have one?
So if I might start by saying that from a supervisory perspective, many years ago, we put into effect guidelines pertaining to incentive compensation, and our supervision is very attentive to aspects of incentive compensation that could lead to excessive risk-taking. It's not focused on the total overall level of pay, but on the potential adverse incentives that could be embodied in that pay.
But that is
And
not the regulation that's called for by law.
It's been very challenging. There are many agencies involved in trying to come up with this, with this
So
compensation
what's the holdup? How do
rule.
we help? Who do I have to kick to get this done?
I can't give you a good answer.
Have you
to
done
that
your job?
question. Well, as I say, we have been working with the institutions now for many years to
Yes, I know, and the
ensure
law
that
says
they're-
90 days. At some point, regulators have to regulate. I'm not complaining that it's 91 days, I'm not complaining it's 365 days, but, and if it's not you, tell me who it is. If it's my friends at the SEC, first of all, I wouldn't be shocked, and second of all, maybe that's a pretty fair thing. Have you done what you need to do to get this regulation required by law, simply to allow us to know the incentives that are involved and to prohibit inappropriate incentives that did help lead to the 2008 debacle? Have you done your job?
We have tried to work constructively with the other agencies.
I love
and
the
we
way
have-
chairs never give answers.
We have done,
I think the Fed has done a pretty good job. I'm not complaining about the Fed, but this one's long overdue. And each and every regulator that comes before me, I'm going to start asking. Again, I'm not suggesting you do a specific item. I don't care how much they make. I care that the incentives are appropriately placed so that the American taxpayer doesn't get put on the hook again on an item that we have already identified as a problem, that everybody agrees was a problem, and that should be relatively easy to fix.
I agree with your assessment that it was an important problem, that it is essential to address it, and as I said, in our supervision, we have addressed it, and we do feel we have seen
And I
very
trust your
meaningful
supervision,
changes.
but I want the regulation that was required by law.
I understand that.
That's what I want. I want the regulation done so that the American people will feel comfortable. Two other items, since my time is running out. One, I want to talk, just basically, I'm not pushing yet, but I'm looking forward to the results of the next iteration of living wills. Back a few years ago, when we had them, they were all of them were called not credible. And the living will provision in the Dodd-Frank, as you know, was pretty important to many of us. We think it's a way to avoid too big to fail. We think it's a way to allow these institutions to say, hey, we're this big, but don't worry, we can take care of ourselves. We don't need any more help. And when they're all called not credible, that's a problem. I know that you're in the process now. Do you have any idea what the time frame might be when you're into the second chance?
So last year, the board, working jointly with the FDIC, sent very detailed evaluations of the living wills to the firms and directed the firms to take action to improve their resolvability that were quite specific
Timeframe?
and quite detailed. We have received those plans. We're evaluating them jointly with the FDIC, and we will be making decisions in the coming months.
Time of the gentleman has
Adequacy.
expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. I'm happy, Chair Yellen, to rescue you from the hostile questioning of my Democrat friend over there. Don't take it personally. He's like that way with everybody. But I do actually want to kind of follow on something that he had point of interest and frustration for a number of us is having to do with the speed or lack thereof where there's been some very specific things that were laid out for the Fed to do. And specifically, I want to talk about Section 13.3. The Fed, Dodd-Frank, required the Fed to adopt regulations, quote, as soon as practicable. That was 5 years ago. There have not been final rules implemented to what federal Fed Reserve restrictions you yourself were going to put as far as, and guidelines as far as utilizing 13.3. And so I'm very concerned that that has taken that long. When is that the Fed is going to issue those final rules?
We expect to issue the final rule by the end of this month.
By the end of this month. I will point out to my friend from Massachusetts, just talk nicely and she'll give you a great answer. So my next follow-up question on that is will the rules address the concerns that Senator Warren, Chairman Hensarling, and others have put forward regarding whether your earlier proposal leaves the door open to future Wall Street bailouts?
So let me just say that we regard our emergency lending powers as very crucial powers. It's very important that, God forbid, there should be a future financial crisis. We hope that won't occur. But if there is, that's why the Federal Reserve was created, to provide liquidity when there is a financial panic and lenders are worried about the state of financial institutions and markets generally. Those powers we used during the crisis to keep credit flowing to the economy.
Sure,
so we want to be very careful about what we do.
Sure, and the words used for that are unusual and exigent circumstances, correct? Okay.
That's right.
Well, in my Form Act, we take that and we say, we add upon it, raise the bar marginally, I would argue, and we use the language, quote, unusual and exigent circumstances exist that pose a threat to the financial stability of the United States. You've come out, and some of the other Fed governors have come out opposed to that language. Why?
Well, that's when we would use, I'm not sure that we have been opposed. That's when we would use those powers when there are unusual and exigent.
I understand,
but
we've
understood to mean pose a risk to the financial system.
We kind of added two things as a belt and suspenders. That was a phrase you used earlier. One was to include the language that pose a threat to the financial stability of the United States, and certainly informally, that is the pushback that we've gotten. I've met with some of the other Fed governors, and they have pushed back, saying we should not address 13.3. The other one that we have is in my bill, Section 11. We also mandate that in addition to the current requirement of 5 of the 7 Fed board governors to approve a 13.3 usage, that 9 of the 12 district federal bank presidents must also approve. Any concern with the belt and suspenders approach that way?
I think the approach that we have currently that's in Dodd-Frank is quite adequate.
So you do have a concern with adding the district Fed bank presidents?
I might have some concern with that.
What concern?
This has always been a board power to decide when to authorize particular reserve banks to engage in programs through the discount window, emergency lending programs through the discount window.
But you understand there's a bipartisan concern and bicameral concern about how that has been used in the past, and that there is too big of a door open yet for these massive Wall Street bailouts to happen, and that what we are trying to address is, in addition to adequate collateral and solvent borrower definitions, we're trying to make sure that there's not just a check and there's just not a rush to find a solution here, but that we also have the Fed bank presidents in there. So,
well, Dodd-Frank clearly restricts the way in which this power can be used, and the rule that we finalize will address concerns about the definition of broad-based eligibility, insolvent borrowers, and penalty rates.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Hensarling and Ranking Member Waters. And welcome, Madam Chair Yellen. Thank you for your appearance here today. Please accept my sincere gratitude for your steadfast leadership at the Federal Reserve. The Dodd-Frank Act reforms paved the way for solid and steady economic growth by restoring confidence in our markets. It's one of the pillars of reform, supporting the creating of 13 million private sector jobs for 67 consecutive months, extending the longest running growth streak in our history and reducing the unemployment rate to 5.1%, the lowest since 2008. My first question is as follows. You indicated in your testimony that the Fed has tailored its regulatory and supervisory requirements for regional and community banks. However, I continue to hear from banks of all sizes in Texas and in my congressional district that they're burdened by the regulation and the costly stress tests required. In fact, one regional bank, Emigi Bank of Texas, one of their facilities is in Houston, spent $20 million in its stress tests alone. In your opinion, do our financial regulators currently have the discretion they need to correctly tailor regulatory and supervisory standards, or should we in Congress take action?
So, Congressman, my understanding is that stress tests are required of banks that are $5 billion and above, and the requirements for the smaller banking organizations are very different than those for the larger, above $50 billion organizations, that they're only required to do a company-run stress tests. For the smallest organizations, there's no such requirement. Now, I did say earlier that we don't have as much ability with respect to stress tests to tailor as I think would be ideal. There are smaller banking organizations where we do see costs of having to participate in the stress tests and benefits that are probably not commensurate. So that is an area that we're focused on, where we're tailoring as best we can, but some legislative change to reduce the burden on the smaller institutions subject to it could be useful.
My next question. Last week, the Fed finalized its total loss absorbing capacity rule for the largest 8 banks. And yesterday, I read in Bloomberg where they reported that Standard & Poor's, as well as the other credit rating agencies, may cut the rating of these banks based on the prospect that the United States government is less likely to provide aid in case of a financial crisis. Can you elaborate for us how TLAC works and how it makes it less likely that a government bailout will be needed in case of a future failure of one of these very large banks?
Well, thank you for that question. It's an important regulation that is intended precisely as you say to mitigate too big to fail, and to the extent that the ratings agencies recognize that a firm is more likely to be able to allow to fail, and they reduce the so-called uplift,
that's here in Congress there is no willingness to repeat what we did back in 2008 to save the banking system. So let me go to the next question.
Yes,
yesterday, we debated replacing the $50 billion threshold for mandated enhanced prudential standards with a Financial Stability Oversight Council designation process. What is your opinion on what the SIFI threshold should be?
So we would not like to see an FSOC process that tells us exactly how to tailor our supervision to firms of different sizes. We already have an elaborate program in which we do tailor the requirements within the confines of law to match the footprint and complexity of the firms. And there are only a few areas where we have concerns that we may be limited in our ability to do that. Stress tests and resolution planning are 2 areas where I'd say the smaller of the firms above that $50 billion threshold, we would like to be able to reduce the burden on them. But generally, we have been able to tailor
Thank you
with
for
the
answering my
threshold.
question.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of the Oversight Investigations Subcommittee.
Thank you, Mr. Chairman, and good morning, Ms. Yellen. When you were here in October, we had an exchange about our lawful subpoena that we made to the Fed. You were unwilling to comply with that subpoena. However, 2 weeks ago, you did comply with that lawful House subpoena, and we are grateful for your cooperation with the House Oversight Committee. In your cover letter, when you provided those documents, you stated that as chair, I have implemented the practice of immediately referring to the Inspector General all suspected material security breaches involving FOMC information. Why is that your personal practice, and why isn't that the policy of the Fed?
Well, the policy of the Fed that was adopted back in 2011, I believe, stated that if the chair was alerted to a breach, that the procedure would involve asking the FOMC's general counsel and secretary to review the matter and to decide whether or not it should be referred to the Inspector
I'm aware of that, but don't
General.
every January don't you meet in regard to the leak policy on the program for security of FOMC information, and you set the policy every year. And since you've been chair, you haven't made that the new policy. You've only made that the personal practice. You could this January change that rule and make it policy, not practice, right?
Well, if it seems appropriate to look at it, it's something that we could do.
So let's go.
My understanding of the existing policy, I'm simply trying to say my understanding of the existing policy is that if there is a material breach, it should be referred to the Inspector General. And
Well,
I have done that. That's been my practice, and I think that ought to be the understanding.
And you can change the policy, I think, this coming January, and I think with all that's happened, you should actually change it from personal practice to policy. But it brings me to a question about the policy. The way it currently is written, if there is a leak, you'll have the FOMC secretary and the general counsel perform a review and then make a request potentially to the Inspector General. But it's fair to say that the general counsel, who would make the recommendation for referral, also is privy to sensitive information, which would mean that there could be a conflict of interest, that the general counsel could actually be the leaker, and he's also, or she's also, the one that's responsible for referring the matter to the IG. Do you see the conflict there? And I think this is ripe for some internal policy review at the Fed. I mean, I'd encourage you to take that under consideration.
Well, let me simply say that I think maintaining the confidentiality of sensitive information is, to me, a very high priority.
I know, but that's not my point. I think that you can see there's an issue here on how the policy works internally, and I think you could work on changing it. I only have a couple minutes left. The Wall Street Journal recently reported that the White House and Treasury were made aware of the 2012 leak. Is that true? Before Congress was made aware in December of 2014?
Not to the best of my knowledge.
But you were aware that they were doing a background check on Mr. Carpenter for a potential nomination from the Fed to Treasury, correct? You're aware of that process? You're not aware of that?
I know that he has been nominated to be Assistant Secretary.
And as part of a background review, are you telling me that they did not reach out to the Fed and ask about his access to this information that was involved in the leak, and you did not provide that to the White House?
I don't have direct knowledge of that.
Do you have any indirect knowledge of that?
That's a particular matter pertaining to an employee. It has to do with the Treasury, and I would...
Here's my, Madam Chair, here's my concern, that we find out in Congress who have the oversight over the Fed, and we find out in December of 2014. However, before the nomination, the White House has this information about the leak. The White House and Treasury that don't have any oversight over the Fed are made privy to not just the internal investigation at the Fed, but also they received the IG investigation. And so it brings
I'm not aware that that's correct. I think It would be maybe standard practice for an agency that's considering a nomination to do a background check, and that might involve
Your compliance.
asking the previous employer as part of the government.
I would agree with
about
that. And also,
individual.
it's common practice for the oversight committee to send subpoenas that are lawful to the agencies in which they oversee, and that agency actually comply with those subpoenas in a timely manner.
I have done my best to do that, and
Thank you.
believe we have now fully complied.
You have, thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Chairwoman Yellen, for your return visit. H.R. 1309 would remove the Fed's ability to make safety and soundness decisions and place them with the FSOC. What impact would this dilution of your authority have on your ability to work with international regulators?
Well, it is important to the Fed to be able to put in place the supervision program that we regard as appropriate for a particular institution. And we would not like to see FSOC involved in determining exactly what that appropriate program would be once a firm is under our supervision. There's no real relationship. I'm not sure when you say international negotiations, I'm not sure what's involved there.
Let
Is
me
there something?
elaborate for you. Under H.R. 1309, designation of banks for enhanced prudential standards can only be undertaken if the FSOC follows standards developed by the International Basel Committee, made up of banking regulators from over 24 countries.
I see.
Do you know of any major nation that defers their domestic bank safety and soundness regulations to a board of international regulators?
No, I do not. That's a very useful committee. We participate actively. We want to make sure that other countries put in place tough safety and soundness regulations that will be good for our firms and for financial stability. But nothing is law in the United States or is adopted as a regulation unless we deem it to be appropriate for our firms, and I believe all countries behave in the same manner. These international bodies are coordinating bodies where consultation takes place, but that doesn't substitute for domestic rule writing efforts
Sure.
here in the United States.
Sure, and that would be a highly unusual arrangement.
Extremely unusual.
Let's shift, Chair Yellen, to insurance capital standards. Now that the Insurance Capital Standards Clarification Act, which gives the Federal Reserve flexibility in implementing capital standards for insurance companies subject to enhanced supervision, has been signed into law, can you please provide an update on the Federal Reserve's implementation?
Well, so we appreciated the flexibility that law provides to us to design an appropriate capital regime for insurance-centric companies that we supervise. We're taking our time to really understand the business models of these firms so that we can tailor the regulations in a way that's genuinely appropriate to their business models. We're working on that. In the process, we're closely consulting with the National Association of Insurance Commissioners, with the Federal Insurance Office, with representatives of the industry and the firms, again, to be clear, we really understand their business models. We want to get this right, and we want to take the time we need to understand what will be appropriate.
Right, and it sounds to me as though you're on the path to getting
We
it
are
correct.
definitely on the path to implementing that.
This week, the Federal Reserve Bank of New York is for the second year in a row hosting a conference to promote the importance of a strong culture of compliance within the banking industry. In light of the seemingly endless series of bank violations on everything from sanctions and mortgage fraud to LIBOR manipulation, the focus on improving bank culture certainly seems appropriate. Can you discuss what the board's role has been in the effort to improve bank culture?
Well, we have been extremely disturbed by the pattern we have seen of violations in a whole variety of areas, LIBOR, foreign exchange. We have imposed exceptionally large fines and, in a number of cases, barred individuals from continuing to work at the supervised institutions or in the industry. And we do fully expect, as part of our supervision, that the boards of directors of these firms will put in place rules and attend to the culture so that we do not see a continued pattern of flagrant violations.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman, and thanks, Madam Chair, for being here. Kind of as a continuation of the questions that Mr. Capuano had, do you all ever sit around as a team and assess the things that were within your control leading up to 2008 that you all were doing sort of a bad job of regulating, and say, hey, we had internal failures here, we were sitting in the room, we were allowing this, we saw long-term capital collapse, we saw the instability. I think Greenspan actually forced the banks to come in and buy the bad assets just because he could and because they're trying to save a system. Have you all sat around and kind of had that discussion internally as a team that we need to do better?
That's a set of discussions we've had over many years, and lessons learned exercises about how did this happen and what do we need to do differently so that it doesn't happen again. And I've tried to describe in some detail in the testimony how we have changed the process of supervision, as well as more broadly our monitoring of financial stability risks in the system outside just the portion that we regulate in order to avoid the problems that occurred.
And if I could then follow that with you're saying the things in the system that provide a risk. So I understand that I'm kind of getting mixed signals whether or not you release the standard on which you evaluate firms, so I'm not quite sure. But my question is, do you really look at the systems themselves? Your comments say that we aim to regulate and supervise financial firms in a manner that promotes the stability of the financial system as a whole. And it's that financial system as a whole that I think provides maybe the greatest risk to the largest firms or all of us. So are you really discussing that? Are you discussing the fact that the BRIC nations are forming the NDB or whatever they're forming, that other nations are trying to figure out how to avoid the U.S. currency because of our actions internally? Are you having that discussion?
Well, we are bringing together a diverse group of people to consider what the significant threats are that could affect not only individual firms, but a set of firms that are large and interconnected.
I mean, with respect,
It could involve foreign threats. I mean, it could, for example, when there were stresses pertaining to the euro area, a focus would have been to how could those
Could you
stresses
share with
spill
me
over.
then the parts of the discussion that deal with China selling down its debt? I mean, with them selling their treasuries, they've decreased the percentage from 74 to 54%. That, to me, indicates a very strong reaction against our policies and against our dollar. And it is maybe the biggest threat. Forget the internal stresses of corporations. Think about that, the fact that the ground we're standing on literally is going to get unsolid and very quickly. So can you share with me the concerns that have been expressed internally about China selling its treasuries?
Well, China has been selling treasuries because its currency has been under downward pressure. And in the market, there is a demand.
Well, then I understand that, and I only got a little bit of time. Don't mean to interrupt. So then let's step aside from that if that says there's no concern there. Look at the fact that we're putting out $1.1 trillion of debt, and you got $300 billion being purchased, and so that leaves a gap of $800 billion. Forget the Chinese, forget everybody else. You, the feds, are going to have to fill the gap with printed money for the $800 billion. 800 out of 1.1 trillion, you all should be saying, this is really outside the scope of what the stress tests are showing us on the banks. So tell me a little bit about that conversation.
Sorry, Congressman, we have no intention, given the economic outlook, of expanding. We're maintaining our holdings of securities that we acquired during the period that we used.
Let me just wrap up. I only got 17
no
seconds.
intention of adding to those holdings.
So this morning in Barron's, they say they compare the situation to Zimbabwe. This morning in Barron's, they say that the Federal Reserve is making itself the lender of last resort. I mean, these are huge warning signs to us, and we're sitting here talking about relatively small stress tests inside different banks. I appreciate the work you're doing. I really think we ought to be looking a little bit deeper. Thank you. Yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Mr. Chairman. Ms. Yellen, let me ask you first about Basel Capital. How is it that the Basel Capital requirement do not recognize the exposure offsetting nature of segregated customer margins that are posted from a derivatives client, and then that goes to a bank, and at the bank they then guarantee the client's transaction with the clearinghouse? And this is particularly when just 5 years ago, we here in Congress, through the Dodd-Frank Act, actually encouraged more derivatives clearing as a means of reducing clients' counterparty risk. So my question is, what sort of message are we sending these clients who post margin to offset this guarantee by not recognizing it as such?
So, Congressman, I'm not sure that I can respond properly to your question. I may need to get back to you on that. I mean, we certainly have required higher margin requirements, both initial and variation, on non-cleared derivatives. Is your question about capital requirements on the assets that are being held? Is that?
Yeah, and I think it's sending a conflicting message to the public, particularly when we, on one hand, are encouraging more derivatives action for risk management, but yet the Basel capital requirements do not recognize the exposure offsetting nature of the segregated customers' margins. So my point is that we need to send a clearer message to the public as to how Basel Capital is interacting with this margin requirement of posting.
So the important message we want to send is we've taken key steps to make the derivatives markets and transactions safer and less a source of risk. And I promise to get back to you on details about how that interacts with Basel.
Yeah, this is very important, Chairman, because as you well know, derivatives and swaps now, as far as using for risk management, is now an $822 trillion dollar piece of the world's economy. And we need to take a little bit better care of making sure we send out non-conflicting information. I want to go back to another question about the designated company. And as a member of ASSOC, you're responsible for determining when a designated company no longer presents a risk to our financial system. So it would be important if you could tell us, if in a little nutshell, exactly when does a designated company no longer present a risk to the financial system and therefore should be de-designated? And in your opinion, is it not important for EvSOC to communicate clearly and publicly with designated companies as to what are those specific risks that they present, so that we can have transparency in the process, so that designated companies and the public will know exactly what a designated company is and what those issues are?
So EvSOC explains very clearly to the company and to the public what the basis was for designation. So it is no mystery at all to the companies what aspects of their business model caused them to be designated. The firms have that information. Every year, EvSOC reconsiders whether or not designation is appropriate and looks at the changes that have occurred in the business of those designated firms since it last reviewed them. If there are significant changes, then a firm can be de-designated. Now,
I want to get this last bit of a question because I want to know what we hearing, if we here in Congress made a move to improve the transparency and due process designated companies received in the de-designation process, what would you recommend we do?
I don't really think it's necessary to do anything because these companies have every opportunity to provide information to EvSOC, to tell us that their business model has changed, to ask the council to consider de-designation. I think, you probably know, for example, that GE Capital has significantly changed its business model. It's decided that it's in their interest to do that. They have not come to EvSOC yet, to the best of my knowledge, to ask to be de-designated, but a company like GE Capital, of course, could present information to EvSOC, and when asked, there would be an active discussion of whether that's appropriate.
Time of the
you, Chairman
gentleman
Allen.
has
Appreciate it.
expired. The chair now recognizes the gentleman from Virginia, Mr. Hurt.
Thank you, Mr. Chairman. I want to thank the chair for appearing before us today. I want to thank the chairman for holding this important hearing. Madam Chair, we have discussed before sort of the dynamic in my rural congressional district in rural 5th District of Virginia, where access to capital is absolutely critical for job growth across all of those main streets, across all that farmland that I represent. It's important to our small businesses, it's important to our farmers, and it's important to families. And I think that those of us who live in rural areas depend disproportionately on community banks. And I appreciate your testimony up front talking about the efforts that you have made to try to tailor the rulemaking, tailor the regulation supervision to try to accommodate the difference in size and complexity of these institutions. But I hope you would agree that despite these efforts, community banks have been disproportionately affected. UVA Law School professor Dean Mahoney, who testified before our committee previously, he testified that Dodd-Frank is in significant part is designed to enhance the regulatory reach of bank regulators. Inevitably, that will mean increasing the size, market share, and political clout of the largest banks. I think if you look at the trend over the last 3 decades, you see that it's been brutal for community banks. Just in the 5 years since Dodd-Frank has been enacted, we have seen a drop in the number of community banks from 7,700 to 6,300, a whopping 20% loss. The rate of consolidation has doubled. This regulatory regime and the supervision has clearly impacted our smallest institutions. I hear from institutions across our district who say, all I have time to do is do paperwork. I don't have any time to serve my customers, to go out and look for new business. In one instance, I've recently talked to a bank president who said, I realized I had a problem when we were up for an examination and we had more examiners, bank examiners in our boardroom than we had bank employees. Those are the kind of stories that we hear as we travel across the district. So I guess my first question really deals with why you are here. We know that the Dodd-Frank Act included one provision that would create a vice chair for supervision. And I guess my question is, let me just tell you what Paul Volcker said. You know what he said after it was included. He said, this new post might turn out to be one of the most important things in there. It focuses the responsibility on one person, and we know this is a Senate-confirmed position. So I guess my first question is do you would agree that effective and balanced supervision is an important part of the role of the Federal Reserve?
Absolutely. It is one of our most important responsibilities, and I spend a great deal of time on it, take it very seriously.
And I guess my next question would be then, if there was, in fact, a Senate-confirmed person in that place or in that spot, how would that affect your ability to focus on what your other responsibilities are in the larger picture? Wouldn't it be good, in fact, as former Fed Chair Volcker said, wouldn't it be good to have that position filled?
Well, Congress created that position, and I would welcome having it filled. I have to say that we now have a division of labor among the governors on the board. We operate through a committee system.
But the Senate-confirmed position remains after 5 years unfilled.
Yes, Governor Tarullo heads our banking
But he's not been
supervision
confirmed. Yeah, but he's not been confirmed for that position by the Senate.
That's correct, but I would say that he's done an outstanding job of leading our work in this area, and all of us do need, including me, need to be involved.
Do you believe
with
that the fact
work.
that this important role and Congress's important role in the appointment of that, does that reflect, do you think, the president's view of whether having a balanced and effective supervision, having somebody, as Volcker said, who's dedicated to this, striking this balance, does that reflect the president's priorities?
You would really have to ask the White House why they're not yet.
Considering that this is the law, Dodd-Frank is the law of the land at this point, at this time, is it appropriate for you as chair of the Fed to press the president to fill this position? Is it appropriate for you to do that?
Well, I think that as I said, I think that we are carrying out our supervisory work in a very thorough and thoughtful fashion, but would welcome a nomination to the position.
Great.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman, and thank you, Madam Chair, for your appearance today. Madam Chair, Dr. King, MLK, reminded us that life is an inescapable network of mutuality tied to a single garment of destiny. Whatever impacts one directly impacts all indirectly. We found this to be eminently true with Lehman and Bear Stearns. The failure of these mega institutions had a direct impact on us, but indirectly, they impacted the global economy, which is integrated to an extent that many of us can't even imagine. I mention this to you, Madam Chair, because it's not just the failure of a bank in the United States that we have to concern ourselves with, but the failure of one of these mega banks in a foreign country because of the indirect impact that it can have on the United States and other banking institutions around the world. I see some value in this living will for these mega institutions and the lesser institutions as well, simply because when we had the failure in 2008, We had a crisis such that banks were reluctant to lend to each other. And when banks won't lend to each other, you don't have a lot of options left. I mention all of this to you because I'm getting to the $50 billion threshold. You've indicated a willingness to see that threshold lifted, but I believe you've also indicated that you would still prefer to have the opportunity, if necessary, to revisit those that are below the $50 billion threshold so as to ascertain whether or not they may become SIFIs by virtue of their activities. So you mentioned lifting it. I'm not going to ask you to tell me at what point you would go to in terms of lifting, but are you saying to us that you still prefer a trigger of some dollar amount? Currently, we have the $50 billion trigger. If you lift it, do you still want a trigger in there of a dollar amount, or are you amenable to going to a means by which only the activities will determine the SIFI designation?
Well, I certainly remain amenable to having a dollar threshold, and to the extent that I've discussed the possibility of raising the threshold, I would really only support a very modest increase in the threshold. Once we get to a slightly higher threshold, we're dealing with institutions, even when we're looking at the large regional banking organizations that are very important suppliers of credit to the country. Collectively, even the regional organizations have probably $1 trillion of more of lending throughout the country. And while conceivably the failure of one of these organizations would not bring about the downfall of the financial system, it could impact a significant portion of the country and the borrowers who depend on these institutions for access to credit. So I think a threshold is appropriate, especially in which banks over that threshold are designated for more intense supervision, especially if we have the ability to tailor our supervision. And the only reason that I have said I'd be supportive of some modest increase in the threshold is because Dodd-Frank does impose some requirements on the smaller institutions in the area of stress testing and resolution plans where we have limited, insufficient flexibility to remove those requirements, and we really think the costs exceed the benefits.
Thank you. Moving quickly to the interest rates, you have a global economy that is weak and by some standards continuing to weaken. How much emphasis do you have to place on the global economy when setting the interest rates within our economy, given what I said about the inescapable network of mutuality?
Well, we are mutual and interconnected. We take global performance into account, and at the moment, what we see is a domestic economy that is pretty strong and growing at a solid pace, offset by some weakening spilling over to us from the global economy. On balance, as we said, we still see the risks to economic growth, and the labor market is balanced, but the global economy has been a drag.
Time of the gentleman has expired. The chair now recognizes the gentleman from Ohio, Mr. Stivers.
Thank you, Mr. Chairman. Chair Yellen, thank you for being here today. The gentleman to my left, Mr. Hurt from Virginia, already talked about the reason for this hearing is statutorily mandated around your supervisory roles. Normally, it would be the Vice Chair of Supervision here, who's supposed to be presidentially appointed, Senate confirmed. That position still only filled by an acting person. Governor Trillo is acting in that capacity. When was he appointed by you as an acting, to that acting position?
I guess I wouldn't call it an acting position. we have a committee system in which up to 3 governors oversee particular functions that we carry out. Supervision is one of those functions. There are other areas, oversight of reserve banks, and so forth. This is a long-standing practice, and the chair of the Committee on Banking Supervision, who's Governor Tarullo, that individual has long been.
So how long has he been doing that?
He's been doing that.
2 years?
I think, well, he
3
did
years?
that under Chairman Bernanke.
Okay.
Since he joined the Fed. I think that was 2009, if I'm not mistaken.
Okay, so 5 years. And so not having him here, even though he's acting in that role, reduces the accountability. It reduces the interaction that the person in that supervisory role should have. So my question for you is, will you commit to allowing him to accompany you to these hearings in the future, these semi-annual hearings?
I mean, Governor Tarullo has testified on many occasions to our oversight committees and usually stands ready to do so. I certainly have no concerns about having him come up and answer questions.
I hope
and
you'll
I'm
bring him
happy
with
to
you
do
next
so
time,
as
because
well.
he's the one making a lot of the decisions. I know you're his boss and you're engaged, but we really need him here because these are important. The next area I'd like to quickly talk about is the impact of regulation. So as you know, we don't live in a static world, we live in a dynamic world, and every time we take an action, there are responses to that reaction, or to that action, and regulation has increased the compliance cost for many financial institutions, created barriers to entry, and actually the result has been a consolidation of assets in the too-big-to-fail banks. It's almost been the opposite of what we as policymakers would have liked to have seen. And on the Volcker rule, the result has been a reduction in the number of market makers, which is a market utility function that provides important liquidity during a crisis. And I guess I would just ask you, are you trying to look at these unintended consequences? Because in both these cases, we are actually creating problems through unintended consequences.
Well, we certainly are looking at consequences, and in particular, in the case of market liquidity that you mentioned, that is something we're looking into very carefully.
And I've asked the OFR to do a report. I hope you guys will do a report on it. I think there are a lot of driving forces to it. There's basic business simplification. There's the Volcker rule. There's the coming DOL standard. There are a lot of things driving it. But I'd like you to do an important analysis of it, because liquidity is so important to anybody, that whether they're a small 401k person or a large corporate entity, because we all enter and exit through the capital markets. If there's no liquidity, the marketplace doesn't work.
Completely agree,
Okay.
and that is why we're looking at it. You know, the agencies, we issued a report on the October 15th episode.
And I have one more thing I want to get to. So
Regular
yeah,
reports on corporate bond
please keep
markets.
looking at it, and I hope you'll look at the Volcker rule as potentially another way to look at Volcker is separately capitalize those activities. It takes away the whole argument and doesn't make it as complicated. Yesterday, your IG issued a report that showed, with regard to stress tests, there were 6 problems that were found in the Fed's own stress test, and if it had been a member bank, they would have required immediate attention. I've only seen media reports on this. I look forward to reading the report on it, but in light of these highly critical things in the report, do you plan to undertake any changes that would create more transparency and accountability in the stress testing and CCAR process with regard to the Fed?
Well, as I understand it, the IG's findings had to do with our model, mainly with our model validation procedures, and those are matters that we certainly will look into and attempt to strengthen.
And I think we should probably request a more complete review by the IG on all of that. Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of our Housing and Insurance Subcommittee.
Thank you, Madam Chair. Thank you, Mr. Chairman, and the ranking member. Chairman Yellen, I think it's been a little over a year ago since since Congress gave you the authority to tailor standards for insurance companies, those who would qualify for enhanced supervision. There is, as you know, a great deal of angst. There's maybe even panic on the part of many of the insurance companies over the fact that they don't know what's going on, and fear what may come. To the degree that you can speak about this publicly, I would present you with that opportunity because it would also help us or help me as I'm asked questions over and over and over again from that industry.
We know that this is a very important matter. We understand that insurance companies are different than banks in important ways. In particular, the nature of their liabilities is in many cases quite different from that of banking organizations. We appreciate the flexibility that we were given to tailor appropriate rules, and we're working very hard to get it right, to understand the nature of the business, to consult with the firms, with the state insurance commissioners, with our colleagues in the Federal Insurance Office. We're consulting widely and thinking very carefully about what the appropriate regime is. When we've made a set of initial decisions, we will go out with a notice of proposed rulemaking likely and ask for comments. And so we will go through an open and transparent process in deciding on what the appropriate supervision is and allow for comments that we will carefully respond to.
Well, I don't want to ask you to give me a date certain, but is the process moving along? And
yes, people are working very hard, and I'm sorry I can't give you a date certain, but this is something that our staff is working on very hard. It's a high priority.
Kind of similarly, the Fed is a member of the International Association of Insurance Supervisors, the IAIS. These acronyms, we got to do something about that with the federal government, especially this committee, Mr. Chairman. We need to do something. But your mission is to promote effective global consistent supervision of the insurance industry. And we are, I think, at a point now where, and maybe it's because of the 2008 collapse, everybody is nervous about everything, and everybody is afraid that there's a new regulation that's going to come in to cause the world to collapse and allow the Mets to win the World Series. I'm sorry, but there is no need for this hysteria, is there?
There's no need for hysteria at all. We are, as I said, looking very carefully at our own firms to design an appropriate regime. And by participating in the IAIS, we're trying to make sure that we weigh in on how other countries set up their own regimes in a manner that will be good for U.S. firms in the U.S. market. It's an attempt to influence what other countries do and thereby to ensure a level playing field that works in our best interest.
Their angst is based on the fact that they believe we might end up accepting standards from the international community that might create problems for them here at home.
Nothing that's adopted internationally has any binding force in the United States. We go through our own rulemaking process and decision-making. It's our internal decisions. Now, of course, given our thoughts on what's appropriate, we're using that and collaborating, doing this collaboratively with other U.S. insurance regulators, we're presenting positions, and Basel attempted to influence the international decisions, but we decide here what's the appropriate regime.
Thank you, Madam Chair.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Holmgren.
Thank you, Mr. Chairman. Chair Yellen, thank you so much for being here. I've been closely following the work of the Fed and other regulators during the Agrippa process. In fact, I sent a letter to you just a couple of weeks ago when a public outreach meeting was held at the Chicago Fed. I'm very supportive of the Agrippa process, and I imagine you are hearing many of the same concerns that I'm hearing from banks in my district. In addition to the report that is mandated to be provided to Congress, what tangible regulatory relief can we expect as a result from this process?
Well, we are listening very carefully to the concerns that are raised in the hearings and in the course of taking comment in this process. And I'm very hopeful that there will be things that we can address and look to change that will reduce regulatory burden. An example of the kind of thing we're hearing, for example, has to do with appraisal requirements that many community banks think the cutoffs are too low and make lending difficult, particularly in rural areas. I'm sure that's something we'll take a look at. Reporting and so forth.
Can I jump in on that? Your written testimony notes the banking regulators have taken steps to reform the call report. As you're probably aware, it's grown from 18 pages back in 1986 to 29 pages in 2003 to nearly 80 pages today. I wondered, would you support legislation requiring the banking agencies to issue regulations allowing for reduced reporting requirement for the first and third quarter, assuming they are highly rated, specifically if they have CAMEL's composite rating of 1 or 2?
So I believe that this is a matter that the FFIEC is studying carefully, and I think there's a mutual desire among the supervisors to reduce burden on smaller institutions. I would suggest that you let that process play out, and we're all trying to do what we can to reduce burden.
Good. Well, we appreciate that, and we continue to hear, especially from our smaller and medium-sized institutions, of feeling the weight of this and growing burden. As you know, the supplementary leverage ratio requires a banking organization to hold a minimum amount of capital against on-balance sheet assets and off-balance sheet exposures, regardless of the riskiness of the individual exposures. These capital requirements yield an economic cost to financial institutions and are a major driver of what assets they're able to hold. Why is the supplementary leverage ratio applicable to funds banks deposit at the Federal Reserve despite the low risk of these funds?
Well, the supplementary leverage ratio is meant as a kind of backup ratio that works as a backup to risk-based capital standards to make sure that the minimum amounts of capital held by banks are sufficient. And it's a requirement that is based on the size of the entire balance sheet of the organization, including low-risk assets such as accounts held at the Federal Reserve. It's reflective of the overall scale and size of a firm's balance sheet. For many organizations, that supplementary leverage ratio is unlikely to be the binding ratio, particularly for the larger organizations that face SIFI surcharges. The risk-based capital requirements are likely to be what's binding going forward.
Chair Yellen, do you share the concern that the minimum interest rate paid by the Fed on these deposits is far below the yield some banks would need to generate in order to offset the economic costs of the capital requirements in the supplementary leverage ratio? And along with that, with just a few, less than a minute left, I wonder what advice you'd give to banks which, as a core function of their business model, hold large cash deposits for their institutional customer base, and also what advice would you give to their customers?
So I'm not positive I really understood the question. You were asking about the level of interest that we pay on reserve balances?
Right, that was the first part of it, and then I was trying to sneak in the last question of advice, again, where banks have a core function of holding large cash deposits for their institutional customer base, and yet because there's a cost with that and it impacts, again, the ratios that they need to hold, we're hearing concern from some important institutions, Northern Trust, others that are feeling pressure from this.
Well, I would say with respect to interest we pay on reserves, that is our key monetary policy tool, and we set that not to cover particular costs of banks, but to establish a level of interest rates that's appropriate for the economy.
My time's expired. I yield back. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of our Monetary Policy and Trade Subcommittee.
Oh, Madam Chair, thank you so much for appearing. It's always good to see you. I was wondering, and I hope that you haven't been asked this question over and over and over again, but I am curious about how going through another round of living wills has informed you and other regulators on implementing the orderly liquidation facility and the cross-border liquidation of large systemic banks and of course, non-bank SIFIs.
So we've learned a lot from looking and evaluating the living wills of the firms that we've reviewed. We have recognized that cross-border issues are among the most challenging. We have made progress in working with those firms to encourage them or even require them to adopt changes in a set of financial contracts that would, under the existing rules, make it difficult to resolve a firm by triggering early termination rights to derivatives contracts. So one of the things that we asked the firms to do in the most recent submissions is to work on that and to change the nature of those contracts. But more generally, over several years of reviewing living wills, we have been able to give very detailed guidance to the firms about what the shortcomings of those living wills are and what we wanted to see in the submissions this year. We're working closely with the FDIC to evaluate this latest round of submissions, and we are prepared to ask the firms for significant changes or if need be, to determine that a living will is not credible.
Thank you for that, Madam Chair. Just as a kind of a follow-up, there have been a lot of critics of the stress tests, and I was wondering how has this criticism informed your regulation, and has it contributed to a better focus in your oversight?
Well, we are currently, I think it's been 5 years now that we've conducted the stress tests. We've learned things in every round and worked with the institutions to try to improve what we do and their understanding and the public understanding of these stress tests. I really want to say that this is one of the most significant innovations in how we conduct supervision. It is a truly forward-looking and comprehensive evaluation of how firms would fare under very stressful conditions of the type that we experienced in 2008 and 2009. The firms themselves, I think, if you were to talk to their executives, they would tell you that they have learned a lot about the risks in their organizations and how to manage those risks because they've been required to engage in such rigorous analysis. And we see some marked improvement in the capital planning processes that are going on in these firms. They're asking themselves hard questions about what capital do they need to make sure they are sufficiently resilient. So this is a very important exercise. It is a core key part of our supervision of the largest firms, and we're reviewing our experience to see if there are some changes we can make to make this more effective and where possible to reduce burden. But this is a major innovation that I believe has resulted in much sounder supervision, especially of systemic firms.
Well, thank you so much. And Mr. Chairman, I would yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from Minnesota, Mr. Emmer.
Thank you, Mr. Chair, and thank you, Madam Chair, for being here this morning. Madam Chair, I'm going to go a different route. I don't think anybody has asked you about this morning. Will the Federal Open Market Committee ever rule out going to negative interest rates?
Rule out is something we tend not to do. I don't, at the moment, see a need for negative interest rates. The committee is seeing a domestic economy that's been proceeding on a steady path of improvement. Our focus has been on the possibility that it will be appropriate to begin to raise interest rates. This is something we're actively considering, although no decisions have been made. Look, if circumstances were to change, suppose the economic outlook, which I don't expect, but if it were to deteriorate in a significant way so that we thought we needed to provide more support to the economy, then potentially anything, including negative interest rates, would be on the table. But we would have to study carefully how they would work here in the U.S. context.
And let me ask you, because we've seen it in other countries.
That's what's new, yes.
Yes, when they've had economic difficulties, we've seen other countries use negative interest rates or go to negative interest rates.
Right.
What impact, Madam Chair, would negative interest rates have on lending and economic activity? What impact do you believe it would have?
Well, most loans would not have negative interest rates, even if a central bank pays negative interest rates on reserves.
I understand, but what impact would it have on
It would be
lending?
intended to spur lending, and I believe would have some at least modest favorable effect on banks' incentives to lend, and it would be undertaken as a measure to support the economy and to encourage additional lending and to move down the yields on interest-bearing assets to stimulate risk-taking investment spending.
I want to change just a little bit. I'd like to talk about this proposal, and if you could clarify it for me, the TLAC proposal that was discussed last week. Was that finalized last week?
No, it's a notice of proposed rulemaking. It's out for comment.
Because it's been around for a while. You've been discussing it for a while.
Members of the Fed, Governor Trullo and others have given speeches on this. It's something that is being discussed internationally in the FSB. In fact, the United States has been contemplating this. We're working jointly with the FDIC. It's an important step in ensuring that the FDIC's single point of entry strategy would be workable in a Title II resolution or in a bankruptcy resolution. We see it as very important. It's been under discussion for quite a long time.
If I can interrupt you, because in the short time left, I have some specific things I'd like to ask you about this TLAC proposal. In fact, some of the analysis that I've been provided regarding the draft proposal suggests that it penalizes firms for what is broadly understood to be a desirable business model, gathering deposits and making loans. In fact, some have even suggested the effect of the new rule could be interpreted as a tax on deposit funding. Would the Federal Reserve benefit, and have you done, because I know this question has been asked before, from a quantitative impact study being conducted by the FSB prior to implementing the new TLAC proposal.
So I think that that's frankly a mischaracterization of this proposal. The purpose of this proposal is to ensure that if a firm becomes insolvent, that there is sufficient.
Forgive me, I've got 20 seconds left. Would you benefit from a quantitative impact study being done prior to implementation?
We have carefully analyzed this proposal, the costs and benefits.
Have you done a quantitative impact study?
We have done a quantitative analysis.
Would you share that with us?
There is information contained in the proposal that we published.
All right, well, the analysis, is there any, well, it looks like
I
my
mean,
time
look,
has expired.
the point is that deposits are not a liability that is capable of absorbing losses when a firm is in trouble. We've seen that in financial crises, and the point of this is to make sure there is enough assets at risk.
Time of the gentleman has expired. The chair now recognizes the gentleman from Delaware, Mr. Carney.
Thank you, Mr. Chairman. Over here, Chair Yellen. And thank you for coming in today for a hearing that you wouldn't normally do. And thank you for filling in for that vacant position and for listening and responding to all our questions. There's been a lot of debate here on both sides of the aisle in the committee over the last several days about regulatory relief, mainly for mid-sized banks and smaller community banks, and you addressed it a little bit in the answer to some of your questions of my colleagues, and I'd like to ask some questions about that. Mr. Hurt talked about these banks, particularly the community banks, as being the lifeblood of our local communities. In most of our districts across the country, particularly our rural districts, not so much my state, which is the state of Delaware, we have fairly sophisticated financial services institutions, it's some of the biggest, and we're not talking about regulatory relief for those firms, but there's been a lot of debate about what's the best way to do it. And one side of the argument is, well, the FSOC and the regulators have the flexibility under Dodd-Frank to tailor these enhanced prudential regulations for the size of the bank. I have a list of the bank holding companies that are $10 billion and above, and so subject to that CCAR process, which is the comprehensive capital analysis and review process that we've been talking about. This is what we hear from our banks in terms of the expense that is involved in all of that. Governor Tarullo said the $50 billion cutoff, these are $10 billion and above. $50 billion and above is a SIFI designation, and you have even additional regulations that you're subject to if you're a $50 billion above. Mr. Tarullo has said publicly that that number is way too low. I talked to him directly in my office, and he said something very far north of $100 billion. We considered a bill today in committee. I did not vote for it. That would have used a different approach. Wouldn't have a size cutoff, but would apply an activities-based approach. What's your view of that? I mean, is there a better way to do it? And part of that question is, do you have the authority? I heard you say earlier that you do not have the authority to appropriately tailor the CCAR process for some of these smaller and community banks.
By and large, we have considerable ability to tailor what we do to fit the complexity and systemic footprint of an institution.
What did you mean when you say we don't have the ability to tailor for smaller banks as necessary? I don't know if that's a direct quote, but I tried to write down the words that you said.
So banks $50 billion and above are under Dodd-Frank, subject to stress testing requirements and resolution plan requirements that, while we can tailor to some extent, we can't completely remove. And what we've found is that for some of the smaller institutions, we think that the costs exceed the benefits, and that's why.
So I'd certainly be interested in having a conversation about what is a better way to do that, and to give you the authority, flexibility and authority to enable you to provide the appropriate tailoring that's necessary. If you look at this list of banks, you know, J.P. Morgan Chase, which is $2.5 billion, trillion dollar bank, excuse me, and is a lot different than the Bank of Hawaii and some of these other Nordstrom Inc., which I didn't even know was a bank. And I suspect that some of those that are much smaller than the top 5 or 6 don't have any systemic risk associated with them and shouldn't be then subject to some of these more expensive. They could do what they do, right, is lend money so people can build businesses and buy homes and the like.
Well, we have 8 banks that have been designated as U.S. GSIBs, and those 8 banks are subject to a heightened set of requirements with risk-based capital surcharges and enhanced leverage ratio and TLAC requirements that the banks below that, those 8, are not subject to. So even among the largest banks, we have been able to tailor our rules.
So I'd be interested in hearing more about how we would tailor for some of the smaller banks. My time has run. Thank you very much for being here. Thank you, Mr. Chairman. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Indiana, Mr. Stutzman.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for joining us today. I'd like to talk a little bit about a comment that you make in your written testimony regarding the lessons of the financial crisis that we have learned. You state to supervise financial firms in a manner that promotes the stability of the financial system as a whole and limit the systemic damage that would result if a large financial institution does fail. I mean, obviously, we always want to learn lessons from different situations that we have experienced. Prior to the collapse in 2008, the Fed was created to, or was focused on financial stability, but we still see about once per generation some sort of collapse. How do you believe that what the Fed is doing now prevents us from another experience like we did in 2008?
So as I try to describe in my testimony, I think the focus of supervision has changed and is now far more focused on financial stability than it ever was prior to the crisis. We are trying to diminish the risks of another financial crisis in a number of ways. Most important, I would say, is to improve the resilience of all of those systemically important firms so that they have much greater ability to survive adverse conditions and to continue to meet the credit needs of the economy. We have much more and higher quality capital, higher liquidity requirements, our stress testing procedures, which I've discussed earlier this morning, are providing a much more robust way of attempting to detect weaknesses in these organizations. Okay. So we're doing that, and also we are working very hard to address too big to fail by making sure that if one of these firms was faced with insolvency, that we could resolve that firm in a manner that would not create systemic risk, would guard the remainder of the financial system from systemic risk.
Thank you. So can I ask you, what portion of your time each week is typically spent on regulatory matters relative to monetary policy?
A good share of my time is spent on regulatory matters. I'm not sure I can tell you exactly, and it certainly varies from week to week, but a substantial share of my time is devoted to regulatory matters.
Do you have any concern that if the focus is on regulatory matters, that it becomes a politicized regulatory the focus becomes more political at some point when you're focused on the regulatory side rather than the monetary side.
I have never seen the focus in regulation to be politicized at all.
As far as the frequency of financial crises, and you would say that, or would you say that any of them were successful as far as the regulations that were in place that kept us from some other greater collapse?
You're talking about earlier crises?
Correct. I mean, prior to 2008, the Fed was focused on. Go ahead.
I mean, I think the United States was very fortunate that from the Great Depression until 2008, we never suffered a major financial crisis. And I think conditions developed prior to the crisis. It was a variety of things that came together that provoked a very, very serious crisis.
Let me ask you this quickly. What do you expect, or why do you expect Basel III to be more successful than Basel I or Basel II?
I think that we have improved capital standards by raising the quantity and quality of capital we demand, particularly of the most systemic organizations, and we've designed kind of backup leverage requirements that also serve to enhance safety and soundness.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Foster.
Thank you, Mr. Chairman, and thank you, Chair Yellen. As you may be aware, there is a shared enthusiasm on the part of both the chairman and myself for contingent capital instruments as a way of stabilizing the banking system. And I've got a copy of a staff memo describing the actions taken last week, the preliminary rule. And it seems to me, I haven't completely digested this, but it seems to me that you are implementing contingent capital requirements for the U.S. subsidiaries of foreign-owned IHCs. Is that correct?
Well, what we've put in place, or what we're proposing, is a long-term debt requirement. I don't think I would use, I'm not sure precisely how you define contingent capital.
It's defined in this memo as eligible internal LTD of foreign GSIBs.
Oh, this is for foreign.
Right, but it's my reading of this that the Federal Reserve Board will be operating the trigger for the conversion of these. Is that correct?
You're talking about for the foreign banking organizations.
Banks, right. Yeah.
So we're making sure that the U.S. subsidiaries of foreign banking organizations that will be required to set up an intermediate holding company have enough, essentially, debt that has been issued to them by their parents, that it will make it easier for them to be resolved.
They accomplish very similar things, but the difference that I see between COCOs and just unsecured debt is that one triggers at insolvency, all right, so that there has to be a determination by the regulator that you're not a going concern and you're going into resolution.
That's correct.
Right? And that is the solution that appears to have been chosen for U.S. companies, whereas you appear to have allowed or chosen the COCO mechanism, where the Federal Reserve Board would say you are in violation of your capital requirements. You're not insolvent, you're in violation of capital requirements, therefore triggering the conversion to equity. And so it seems like you have, so my question is, do you have in place, and will the Federal Reserve Board be operating that trigger mechanism in the case of the foreign-owned subsidiaries?
So clearly in the case of the U.S. subsidiaries, what we want is, in the Title II resolution, enough loss absorbency for the FDIC to be able to recapitalize a bridge holding company.
Right. So I view this, the European solution, the COCO mechanism, as superior because it warns the banks when they're in danger of there's a market-based signal that warns the banks when they are likely to be in violation of their capital requirements, not that they are likely to become insolvent. Right? So, and do you understand? And that I view as a major difference. I think that the political nature of that decision will be much easier and less fraught if you're talking about triggering the conversion to equity rather than just sending the firm into resolution. And so for that reason, I think it's likely to be less politicized. And moreover, it is much more likely to yield a going firm at the end of this. And so I was wondering why you had decided then, to allow for foreign subsidiaries, the mechanism of COCOs, and yet not included in the capital stack of U.S. firms, and what the thinking was behind that.
So I'm not sure if I'm going to be able to explain this to your satisfaction, but we think in the case of a foreign firm, many foreign regulators, if a firm got in trouble, would want to essentially engage in a single point of entry type of recapitalization, and the structure that we've proposed, I think, would make that possible. We would end up cooperating with a foreign supervisor who was trying to resolve a firm. Now, if there were problems,
the COCOs don't trigger when the firm needs resolution, right? As I understand it, the COCOs trigger when the firm violates its capital requirements, but is not yet insolvent. Is that
if a firm were under our supervision in the United States to violate that requirement, we would demand, I guess, that it be refilled so that if the firm were to be in trouble and we needed to resolve it, it wouldn't operate in the manner you suggested.
All right. So I guess, it sounds like you have in place the trigger. Because when I brought this up before, the response that I've gotten was, well, the trigger is too complicated for us really to set up. Whereas in fact, it seems like you plan to set up such a trigger. Anyway, would it be possible to, get me a briefing on that?
Yes, certainly. We'd be glad to do it.
Time of the gentleman has expired. The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Thank you, Mr. Chairman. Madam Chair, I know it's a relatively minor issue in the greater scheme of things, but since this is an oversight hearing more than it is a monetary policy hearing, I want to go back to Congressman Duffy from Wisconsin's line of questioning regarding the 2012 leak, generally your policies on those sorts of things when we're dealing with what we call information security rules. Mr. Duffy asked you a question. I don't know if we're able to get to the bottom of it. He said in your cover letter to him of about 2 weeks ago, reducing the documents, you wrote the following, quote, "As chair, I have implemented the practice of immediately referring to the Inspector General all suspected material security breaches involving FOMC information," end quote. I believe that's from your letter. If it's not, please let me know, but I think that's fairly accurate representation. And his question was, why, and my question still is that you say you have implemented the practice. Why hasn't that become part of the formal policy of the Fed since you've been the chair? Because the policy is different. The formal policy is very different than that, as a matter of fact. So help me reconcile your practice and the formal Fed policy.
Well, the formal Fed policy says that in the case of a purported information security breach, there should be a review by the FOMC secretary and general counsel to determine what the next step should be, including whether it should be referred to the Inspector General. Now, my understanding of that policy, the way I understand that, is that if there is a material breach, it is appropriate to refer it to the Inspector General, and I've done so. If these rules need clarification, that's how the FOMC chair is tasked with handling these investigations, and that is my understanding of the rules and how I intend to proceed.
Let me see if I can cut to the chase on this. I think what you're saying is that you believe that your practice is entirely consistent with the policy, and that what your letter really said was, after, without saying this, after the general counsel did their investigation, I would immediately refer it to the Inspector General.
Well, I've taken the view of, as soon as we've determined that there is a material breach, I have asked the Inspector General to look at it right away.
Right, and you wouldn't determine there's a material breach until after the general counsel and the Secretariat had done their...
They need to do a review. I mean,
correct.
Let me just give you a sense of
I know this is
kind
going to
of
stun you,
thing
Mrs. Yellen, given our history, but I'm actually agreeing with you. So if you want to just take yes for an answer, we can move on
Yes.
if you like.
I mean, look, the kind of thing that happens is sometimes somebody has a USB with a a draft of something on it and it drops out of their pocket in a taxi, or they lose their BlackBerry. Now, there are security procedures both in USBs and in BlackBerries that just basically should disable them and protect the information. But the FOMC secretary receives reports of such things. In general, I wouldn't refer such things to the Inspector General, but something that is a material breach, I would do so and have done so routinely.
Fair enough.
There have not been a lot of things, but
Before we go back briefly to the 2012 leak, let me just simply ask you the question. Have you ever actually activated this practice since you have been the chair at the Fed?
The practice of referring to the, yes, I have.
And have you disclosed all of those referrals to Congress?
I'm not certain. For example, I think we did disclose publicly that a portion of the Fed staff's forecast was accidentally disclosed on a website, or it was included on a website.
Fine, and again,
that was referred.
And I'm familiar with that example. I'm asking you if there's ones that we don't know about. Have there been referrals to the Inspector General that you've not notified Congress of publicly or privately since you've been the chair?
That have not told Congress about it?
Yes, ma'am.
I need to
Fair enough.
check on that.
Let's go back. Oh, by the way, one final change, and I know this is splitting hairs, but I used to be a lawyer in the real world a long time ago, so this is the type of stuff that catches my eye every now and then. Y'all switched the policy on the security breaches somewhere about 2014, 2015. You're shaking your head no, but you did, right?
We made a small change, and I know it has been alleged that that was a weakening of the requirements. It absolutely was not in any way
So if I may, Mr.
weakening
Chairman,
of our requirements.
very briefly, it's your testimony, ma'am, that the small changes in language, changing an investigation from a full investigation, was not intended to change the scope of the rule at all.
Absolutely not, and there was nothing about, as far as I know, about full investigation.
Thank you, Madam Chair.
Time of the gentleman has expired. The chair wishes to inform members that Chair Yellen will be departing at 1 o'clock. Presently, I think we can clear the queue in the room. Members who may be monitoring from their offices, you are out of luck. Chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you, Mr. Chairman. And Madam Chair, thank you for being here. Indeed, thank you for your outstanding public service.
Thank you, I appreciate that.
I think you've probably heard something closely resembling consensus here today from both sides of the aisle about concerns regarding regulatory relief. Many of us share your commitment to providing for both prudential protections as well as consumer protections, as well as enabling the free flow of credit, but with a belief on our part that that could be done with a bit of a lighter touch. I'm hearing that somewhat from you today. Indeed, my perception is that the regulatory structure is in fact moving from what I would characterize as actively resistant to receptive.
Very receptive. We are actively looking for ways that we can safely diminish burden, particularly on community banks, but also smaller institutions that are, for example, subject to the 165 rules in Dodd-Frank, those over 50 billion. So we are very receptive and actively engaged.
So my encouragement would be that you would move it from receptive to being proactive. And in the spirit of that recommendation, I want to, and if this has been asked, I apologize, follow up with your testimony where on page 11 you indicate that the Reserve is giving all of these suggestions careful consideration and will be working closely with other banking agencies in developing a report to Congress at the conclusion of the EGRPRA review, which is a deregulation exercise. Approximately when can we expect the report?
I'm not sure. Do you know when that's over? The GRPRA? By the end of next year, for sure.
By the end of?
By the end of next year, for sure.
By the end of 2016. Then I would encourage you to see if there is any distance between the pedal and the metal on velocity of that effort, because I think it would play a very constructive part to move from receptive to proactive. I think it's important that you all be a part of this, because frankly, otherwise what I observe here is you have those who legitimately believe that we can do a whole lot less, but that which many of us believe would compromise prudential considerations and consumer safety considerations, and so we react accordingly.
Yes.
And the positive, constructive advancement on your part, I think, would be very helpful to all.
I think that's completely fair, and I pledge that we will try to be proactive in actively looking for ways that we can reduce burden.
I have another question. We tend to think about the Fed's monetary policy as its big lever to deal with the issue of price stability and the Fed fund rate that you set. But if I understand this thing correctly, and I may not, you also have the ability to set the interest rate that you pay on excess reserves that member institutions have with you, which seems to me to have potentially the same benefit as hiking the Fed funds rate, because if they are incentivized to leave more money with you, it's less money that they lend out, which is tapping the brakes on inflationary pressures. Why would you do one over the other? What are the comparative benefits of doing just Fed funds rates versus looking at excess reserve rates?
So the interest we pay on excess reserves will be the key tool that we use in order to raise the federal funds rate. The federal funds rate is not something we can decree. It is a market-determined rate. And when we decide it's appropriate to raise that rate, we will accomplish it by raising what we pay on excess reserves. They are intimately connected, not two separate tools. Interest on excess reserves is critical, and we expect by raising it that short-term interest rates generally on money market instruments will all rise across the board. And
can I see if I can get one more in 14 seconds?
Yes.
One of the rating agencies recently indicated that the exercise of living wills is actually working, and they put it in writing. We're about to go through another round, I think, this winter. What is your forecast for what the impact will be?
We have very detailed living wills. They are much more detailed than previous versions. They've responded to instructions that we carefully gave out. We are carefully evaluating them, and we'll be making decisions in the coming months.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Afternoon, Chair Yellen. Chair Yellen, I'm going to see if we can set some kind of record together and answer 5 questions in 5 minutes. I'm following up on Chairman Hensling's questions regarding the role of the Fed in the boardroom. And I'm going to read a quote from the Financial Times in August of 2014 that said, Fed officials are also involving themselves in the kinds of decisions the company management or board directors usually make, including whether employees should be fired or disciplined, which has been surprising. Ms. Yellen, do you support this type of activity, notwithstanding that you said it's not the policy, but do you support this type of invasive participation by the Fed? Would you approve of it?
Well, when there is wrongdoing, as we've seen, for example, in the LIBOR or FX scandals, it is appropriate for us, in addition to leveling fines, to try to identify individuals who are guilty of wrongdoing.
As an ongoing process, do you think it should be a matter that the Fed, for example, should be opining on human resource decisions and so forth inside the boardroom, as was quoted here in the Financial Times?
So, I'm sorry, what exactly did they quote?
Well, they just said that they were including whether employees should be fired or disciplined That was one of the comments that was made.
I'm not aware that we.
Would you approve of that? Would you approve of them opining out on whether this should be done or not?
We should not be managing firms. We should be making sure that firms have
So do you
in
you don't
place
believe that the
appropriate
Fed
systems.
should the Fed then be micromanaging these boardrooms and trying to dictate policy inside of a boardroom?
We're not managing the firm. We shouldn't be managing the firm, but we need to make sure that the firm is managing itself properly.
Chair Yellen, following up on Mr. Hurt and Mr. Hinojosa regarding community banks, what reforms, if you could give some clarity on this further, would you say that the Fed could do to reduce regulatory burdens on community banks? And also, what would you recommend that we as a committee could recommend to provide some type of regulatory relief for community banks to ensure that they can provide the best services and products for the consumers?
Well, there's a lot that we can do on our own, and we have been doing it. We're trying to do more work off-site so that we have fewer examiners spending less time in actual banks doing exams. We're trying to tailor our exams to the areas that are really high risk, either in terms of consumer compliance or safety and soundness.
Chair
there are
Yellen,
many steps.
pardon me, have you had occasion to go out and visit some small community banks?
Absolutely.
How many have you seen?
Many over the years that I've been involved with the Federal Reserve.
In the last 2 years, have you been out to see any community banks?
Since I've been at the board, I haven't made trips to see community banks, but I meet with many community bankers. You know, we have the so-called the CDAC, which is, in fact, we're meeting with the CDAC on Friday.
I think if I could interrupt, I think a more in-depth awareness and understanding. I was on a community bank board for 10 years, and just to go visit these banks yourself, it would make a major statement of your own, the importance that you see for community banks. I think you would get a sense from the staffing of what they're addressing, and you can hear from a CEO and a bank chairman, but I would really encourage you to do that. As you look at the imposition of the regulations on the financial industry, it's had really indirectly a major impact on industry that's left our country and moved offshore. We've seen that occur too many times. What do you think can be done to make sure that we can provide the financial resources available and not have the regulatory impediments on financial institutions that frankly impact our business growth and their environment? They're leaving here, and that's part of the problem.
Well, this is partly why we participate in international groups like the IAIS or the Basel Committee or the Financial Stability Board to work
How would
with
you
other
measure
countries.
success in this approach? I mean, do you think what you're doing is working now? Because we haven't seen the measured success that we would like to see in terms of being able to attract companies who want to stay onshore.
Well, I think we have seen success, that we have a much safer and sounder financial system, and other countries are also raising the standards that they apply to their large
Thank you.
banking
My time's
organizations.
expired.
Time of the gentleman has expired. Chair now recognizes the gentleman from Minnesota, Mr. Ellison.
I thank the ranking member and the chairman. Thank you for being here, Chairman Yelling. Really appreciate it. You know, we had this big debate yesterday and the votes today on whether or not the $50 billion designation is you know, the right metric for SIFI designation. And I tell you, I'm sympathetic to changing it, but I didn't vote for either one of those proposals because I feel that after there's a big crash, then we regulate, and then before the ink is dry, we're all trying to change it suddenly. And is it good or is it bad? And so what I want to see when a proposal comes back to change it from, and so there may be a growing consensus that 50 billion could be different, but we don't have a consensus on what it should be. And I guess my point to you is, knowing that our constituents lean on us to do things that they want, our constituents aren't thinking about the system, they're thinking about their business, and that's a generalization, but I think it's generally true. I'm looking for good guidance from people like you as to if it's not 50 billion, what should it be and why? And so I'm sure that this issue's not going away, you know, and so I just want to make that point clear, because I definitely believe that, you know, the $50 billion designation, you know, the truth is that it is a imprecise metric. I'll agree to that. But there were some regional banks that caused some major damage in the last go-round. So I'm not willing to walk away without a real clear plan as to what's going forward. Do you have any reaction to that?
I agree with that, and we have said modest increase, not a large increase, a modest increase. And while I think there would be some benefits to the smaller banking organizations that are over that 50 billion threshold and would save us some supervisory resources, this isn't a must-have.
Okay, well, so on living wills, the very largest banks in the country are even larger today than they were during the financial crisis. The living wills provision of Dodd-Frank was created to make sure these banks never threaten the economy again by giving regulators additional powers if banks' living wills are found to be not credible. The last time the Fed and the FDIC evaluated these banks' living wills, only the FDIC took the official position that the wills were not credible. The Fed's decision not to join the FDIC has slowed both regulators' ability to take additional action. Why would the Fed voluntarily give up additional authorities to force changes at problem banks?
So we took the position that this was a completely new process, and we stated this when we put out guidance on the living will process, that we expected to have to work with firms for a few rounds in order to understand what we needed to see in a plan and to give firms reasonable guidance on our expectations. Last summer, that is why we declined to join the FDIC last summer and did not vote to find the plans non-credible. But we've worked closely and jointly with the FDIC over the last year to give very clear, very detailed, and we're asking for very substantial changes on the part of these firms. They have submitted a new round of living wills. We're evaluating them with the FDIC, and in the coming months, we will make important decisions.
Thank you. With my last minute, I just want to know if you'd be willing to offer your perspective on one of the observations of Ben Bernanke, who, as you know, he came out with a memoir recently, and in there he said something like this: it would have been his preference to have more investigations of individuals' actions, as obviously everything that went wrong or was illegal was done by some individual, not by an abstract firm. And so in that respect, there should have been more accountability at the individual level. And then, of course, Loretta Lynch under the DOJ just said about a month ago that they're going to look into white-collar prosecution a little bit more. Do you have any observation on Mr. Bernanke's observation? What about prosecuting some of these folks who engage in fraud?
I completely agree with his assessment. Now, we can't engage in criminal prosecutions, but I would say to the extent that we can identify individuals who have been responsible for wrongdoing and significant breaches where we've leveled big civil money fines. We are trying to take action against individuals as well, and that means barring them from working for those organizations or potentially for the banking industry.
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr.
Thank you, Mr. Chairman. Chair Yellen, welcome back to the committee. We routinely hear from President Obama and Senator Warren and others that an absence of regulation was the principal cause of the financial crisis. I'd like to explore with you today the threats to financial stability posed by too much regulation. Let me take as an example the CLO market, collateralized loan obligations. This market provides more than $400 billion in financing for hundreds of American companies that employ more than 5 million people. They are a crucial source of funds for many companies that cannot issue bonds. CLOs also performed extraordinarily well during the last 20 years with a negligible default rate. They performed better than high-grade corporate bonds over that same period of time. Unfortunately, we are hearing from market participants that the risk retention rules promulgated by the Fed will cause a contraction in the CLO market and a credit crunch for American companies. Alternative sources of funds are available through hedge funds and the like, but they are not a stable source of funds, and they will certainly demand a much higher interest rate. Do you believe that American businesses are better served with expensive short-term financing from hedge funds as opposed to stable long-term financing options?
Well, we want to make sure that businesses have stable long-term financing sources, but we also want to make sure that when securitizations take place, that the originators do have skin in the game so that we avoid the kinds of problems that happened previously, and that's what those QRM rules are designed to accomplish.
Well, I appreciate it. I would make a distinction between securitized mortgages, which were at the epicenter of the financial crisis, as opposed to highly rated commercial, senior secured commercial and industrial loans that never defaulted in 20 years. But I do appreciate the point about skin in the game, and I wanted to just ask you about a letter that we sent to regulators. I joined a bipartisan group of members of Congress who wrote to you recommending that you support the concept of a qualified CLO, much like a qualified mortgage, a structure that would ensure the safety of these vehicles, but also ensure a continuation of financing to hundreds of companies that rely upon them. Is that something that you would be open to?
I think it's something we could have a look at. I'd have to get back to you on it.
I appreciate that. I'd love to have that discussion with you. Let me move on to the issue of illiquidity in the market generally. Secretary Liu has denied that there's a liquidity issue or that some of the post-crisis regulations are contributing to illiquidity in the market. In your previous testimony before this committee, you said that you would not rule out the possibility that regulations are playing a role in decreased fixed income liquidity. Certainly your colleague, Lael Brainerd, acknowledged that regulations may be a factor in diminished fixed income liquidity, and there's been a lot of research on this. I'm quoting from one often cited piece of research. Almost every institutional investor in almost every market seems worried about liquidity. Even if it's here today, they fear it will be gone tomorrow. They say that e-trading is contributing to volume but little depth for those who need to trade in size. The growing frequency of flash crashes and air pockets, often without cause, adds weight to the fears. And the most frequently cited explanation is that increased regulation has driven up the cost of balance sheet and reduced the street's appetite for risk, and hence their ability to act as a warehouser between buyers and sellers. What would lead you to doubt that increased regulation is actually creating a destabilizing impact in terms of liquidity?
Well, it's just there are a bunch of different things going on in these markets, and we're trying to carefully study, and it's, the Treasury market and the corporate bond market aren't the same. The conditions are quite different, and the role of the broker-dealers is different. High-frequency trading has become very prevalent in the Treasury market, and
I hear that explanation. Let me just jump to one other potential theory here, and again, the same piece of research. The more liquidity central banks add, the less there is in markets. In addition to regulation, central banks' distortion of markets has reduced the heterogeneity of the investor base. And so the question is central bank liquidity forcing investors to view fixed income and equities as expensive, making markets more prone to sudden corrections?
well, we hold significantly more assets, the Federal Reserve and other central banks, than we did prior to the crisis, but we have very deep and liquid markets in the Treasury securities and mortgage-backed securities that we hold. So I'm not aware that our behavior is significantly influencing market functioning. I'm not aware of any evidence suggesting that.
Thank you for your testimony.
Time of the gentleman has expired. To accommodate the chair's schedule, the gentleman from Maine will be the last member recognized. Gentleman from Maine, Mr. Poliquin, is recognized for 5 minutes.
Thank you, Mr. Chair.
And thank you, Chair Yellen, for being here. And you notice they always save the best for last, Chair. That's what they say up in Maine anyway. But I'm thrilled to have a discussion with you in the lobby before we came into the hearing, Chair, where I had asked you specifically what your thought process is now going forward about FSOC and your involvement in FSOC is designating asset managers, pension fund managers, mutual funds as systemically important financial institutions. And if that happens, of course, they have to succumb to smothering regulations with respect to Dodd-Frank, and that can stifle rates of return for small savers. And you mentioned me something that was very interesting. You said, right now, the Fed is not focused on designating asset managers as SIFIs.
I've said that, what I said was that the FSOC is focusing on activities and studying a set of activities involved in asset management, liquidity risks, redemption risks, potential risks that have to do.
Thank you, I stand corrected. And you, of course, sit on FSOC.
That is right. That's FSOC's focus at the moment. It's studying these areas. The SEC is actively involved in rulemaking in these areas, and that has been the focus recently in FSOC.
Thank you. You know what would be really helpful, Chair Yellen, if I can suggest, is if we had a written set of criteria that the industry, those folks that are in this space, can look at something on paper to say, you know, if I have these various business practices that revolve around my business model, or I manage these sort of assets, then I know the probability of me being designated as SIFI is very high or low. Does that make sense to do something like that instead of saying, well, our focus on FSOC is not to look at asset managers as designated as SIFIs, but maybe down the road we will. Do you have a written set of guidelines so folks in this space can see?
There were a set of criteria that FSOC initially issued to indicate firms that it might look at.
And has that been updated, Chair?
I'm not certain if it has, but there was a written.
If you don't mind, we'll reach out to your staff to see if there's any updated criteria on that. Okay. And do you also, Chair Yellen, have a set of criteria that deals with an off-ramp, such that if an institution, a non-bank financial institution, is designated as a SIFI, and they know if they go down this path and de-risk in your eyes or the eyes of FSOC, there'll be an off-ramp for them. Do you have that set of criteria?
We evaluate each of these firms every single year to decide if it's no longer appropriate for them to be designated.
But do you have a set of written criteria, Chair Yell? Because if you're running a business, it's really helpful if you have those guidelines.
We're not trying to run these businesses, and we're not going to, I don't think it would be appropriate for us to say you need to do X, Y, and Z to be de-designated. These firms understand very well why they've been designated, and they understand what kinds of changes in their business model would change that assessment.
As a member, if I may.
And, you know, these are firms that have decided they want to do this kind of business. And if they change that decision, of course it's possible.
Here's what I worry about, Chair Yellen. I don't mean to be rude, but I only have a little bit over a minute left. Here's what I worry about. You've probably seen this study that was conducted by Holtz Eakin, who's the former director of the nonpartisan CBO.
Yes.
And when you have pension fund managers or mutual fund managers that are designated as SIFIs, he concludes that the long-term rate of return of these retirement nest eggs are likely to go down up to 25% if they have to succumb to these Dodd-Frank regulations. So it is my contention that when you have a trucker in Bangor or a teacher in Lewiston, Maine, the greatest district, the greatest state in the country, and they're doing their best to put aside $50 or $100 a month to make sure they plan for retirement, but because of these Dodd-Frank regulations over an industry that poses no systemic risk to the economy, if that happens and these regulations prevail, then these folks have to work longer or have less money in their nest egg. And that's not fair, it is not compassionate. So all I'm asking of you is, if we as a member of Congress, I represent 650,000 of the most honest, hardworking people you can find in this country. I just would like to see
what written criteria you have such that these pension fund managers, these asset managers, know how to be de-designated as a SIFI.
None of them have been designated.
I know, but wouldn't it be great if they knew what would cause them to be designated and how they could get out of it?
Well, FSOC has not designated any asset manager.
And thank you for doing that, but it would be wonderful if we had criteria so going forward, we know what that'll look like.
Time of the gentleman.
Thank you, Chair Yellen.
Time of the gentleman has expired. I want to thank Chair Yellen for her testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. I would ask, Chair, that you please respond as promptly as you and your team are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.